Good morning. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And here are three things you need to know this morning. Meta beating the street on the top and bottom lines as optimism over ad revenue offsets fears over rising expenses. The social media giant saying a recovery in advertising will drive revenue growth at the fastest rate since 2021. Much of the talk was also focused on the new Threads platform, with CEO Mark Zuckerberg saying it could hit 1 billion users, and pouring gasoline on the platform will give it the boost it needs. If gasoline is the answer, it might need a lot, though. Users have been declining and engagement has been declining since that initial pop of euphoria. Yahoo Finance's Akiko Fujita interviews Meta Chief Financial Officer Susan Lee. That is coming at 3:10 p.m. Eastern today. That is an interview, of course, you will not want to miss. Supersized results. McDonald's comfortably beating the street with same-store sales rising 11.7%. That's more than the 9.4% expected by analysts. In the U.S., that number was 10.3%, also above estimates and continuing strong momentum there. Some of the credit goes to a, quote, large purple rotund being of indeterminate species with short arms and legs. We're talking about Grimace, the purple McDonald's mascot, experiencing something of a resurgence of late. You might have been haunted by some of the memes and videos that you have seen. That's been helping drive customers to U.S. restaurants. And the sales growth miss weighing on shares of Chipotle. The chain's revenue grew 13.6% to $2.5 billion. Same-store sales up 7.4%, which was a miss. Operating margins rose in the second quarter, though also underwhelmed. Inflation has been an issue for the company. The chicken al pastor, something of a savior there. The lower cost item also gave a boost this past quarter. Stay tuned. We'll be speaking with the CFO later this hour.
Meta shares are up 9% this Thursday morning after the company posted an 11% increase in revenue, beating the street estimates for the quarter. Meta's ad sales drove revenue higher than expected, and the tech giant's ad impressions, a key to the company's monetization of its platforms, that jumped 34% actually year over year, as the price per ad went down by 16% in that same period. Meta CEO Mark Zuckerberg said in a statement on Wednesday, "We continue to see strong engagement across our apps, and we have the most exciting roadmap I've seen in a while with Llama 2, Threads Reels, new AI products in the pipeline, and the launch of Quest 3 this fall." Let's bring in Brad Erickson, who is the RBC Capital Markets Internet Equity Analyst, to weigh in here. Brad, great to have you here with us to kick off this conversation and kind of the recap of Meta's earnings and the outlook and the guidance. I want to kind of get your high-level and top-line takeaway from the earnings.
Yeah, nice to see you, Brad. So I think at a very high level, what's going on here is Meta's kind of doing two basic things. One, they're creating products that are driving people to spend more time and, frankly, gain more functionality on their platforms, such as Reels, such as things like messaging with businesses and other things. And certainly you mentioned Threads, right? That's one half of it. The other half is that they're using AI and they're having people do a lot of this marginal engagement on the platform, meaning they understand exactly what they're doing and they understand the output from an advertiser perspective. And so the way I always talk about this is you got your price and your quantity. They're affecting both of those things in an upward way right now, and it's really helping the business a lot.
I'm curious about this narrative, Brad, that even though they're still spending a lot on their new initiatives, including Reality Labs, which of course continues to lose money, that it matters less when they're bringing in that ad revenue. Is that a fair assessment?
Totally fair assessment. Yeah, it's kind of, if you're driving the top line growth, you're showing people fixed cost leverage on other aspects of the business. The way I say it is Mark's getting a lot of leash now from investors who are willing to underwrite those longer term projects. I would say I still don't think there's a ton of belief in what they're trying to build within the metaverse. But again, given the top line trends, given the earnings flow through that they're seeing right now, they've got some rope to work with.
When we think about the cost restructuring that a lot of companies had talked about and how that impacted marketing and advertising budgets, you've got a couple reports from this earnings season to look through to kind of see exactly where campaigns and spending are still moving forward. Is the worst of that cost restructuring that's impacted marketing budgets and advertising thus seen through some of the revenues from companies like Alphabet or Meta or even Microsoft, if you want to throw them in there to a certain extent?
Yeah,
Is the worst of that behind us?
At least at this point, from what we can tell, and obviously we do our own research on this topic specifically, I think so. What we're hearing is that, a lot of companies are still very, very uncertain around the future, and they're definitely struggling with we'll call it operating cost inflation, wage inflation. And so there's kind of two buckets we're hearing in terms of business priorities from a lot of the business agencies that we talk to, where we get a read into the ad channels. The one bucket is things that drive revenue today, right? That's direct response advertising in many cases. That is Google, that is Meta. And then there's all the other stuff that doesn't necessarily drive revenue either today or ever. And I would say in those cases, what we've heard is those areas continue to be soft, meaning businesses are still looking to cut their eliminate projects, pause, what have you. But people still, but on the other side, they are prioritizing advertising. And I think that's what we've seen show up clearly this earnings season.
Brett, at the same time, I was struck not just by Meta, but also by the likes of Alphabet, that even as things do seem to be looking up, the language and the tone, at least, is still very much focused on cost discipline, right? What do you think? Do you think that the cuts that we're seeing on the part of the companies are sort of done at this point? And what is that cost discipline going to look like for the next 6 months to 12 months?
Yeah, I think when you've come through the period we've just come through, right, the macro tumult over the last 12 to 18 months, I think management teams, and in this case for Alphabet and Meta, I think there's clear recognition that they have an expectation to deliver a tone of fiscal prudence, diligence, and efficiency on the cost side of the equation, right? It's not 3 or 4 years ago when you can just invest in endless science projects and the growth rates were high enough where nobody cared. People cared now. So I do think you're continuing to hear that narrative. I think in Meta's case, they've probably reached a point where they're more at kind of like a good new baseline for efficient run rate operations. I think Google, in some cases, I think they're, based on their commentary earlier this week, they keep talking about durably re-engineering their cost base. I do think there's probably a bit more ways to go in terms of trimming fixed costs there longer term.
Brad, they brought up Threads on the call, and of course that was within the question and answer period as well. So we got a little bit more color, but I wonder from your perspective, the type of timeline that you would like to see Meta platforms monetize Threads.
Yeah, I think, they have so many good other product cycle initiatives going on right now, certainly growing things like Reels. They're doing a lot of cool stuff in terms of business messaging. They're expanding the browser and things you can do there. Shopping ads are really effective. All of those things are incremental drivers for the business right now, today, driving material revenue growth, which has nothing to do with Threads. So my preference, honestly, would be to see them really look to enhance the Threads product and platform and grow the usership of that and see where we go before we think sort of about monetization. And frankly, I thought it was interesting last night, Mark alluded to the fact that it took very few engineers to build that. I think, honestly, this is one of these projects where they're going to be able to invest a bit into it, but nothing that's going to sort of break the bank. And they're probably going to be able to grow that platform over time. So I think we're still optimistic over the longer term that can turn into something material.
What does that look like? I think he floated, 1 billion users for Threads alone, I think. Is that realistic? What do you think the potential is?
Yeah, I mean, when you're starting off of a base of not quite 4 billion overall in the family of apps, no one else has a better distribution channel to cross-sell into a new platform.
Yeah,
so, yeah,
I will say, Brad, I don't know about you. I signed up for the thing, like 99.999 billion other people did or whatever. I looked at it a couple times the first few days. I haven't really been looking at it after that, and that's been reflected in a drop in engagement. So I'm just wondering, how do they keep those people from just defaulting to Twitter, which is what I just went back to?
Yeah, look, it's going to be a steady shift over time. The product is clearly very, very underbaked. In some ways, candidly, I think they probably surprised themselves in terms of the initial adoption. And so maybe there's a little bit of product development hustle going on to to catch up to that. But no, it'll just be a steady shift. I think for a lot of folks who are regular Twitter users, right? Twitter is the type of platform you wake up and it's the first thing you check when you get out of bed in the morning. That behavioral change will take time to come over, but obviously it starts with content and the content creators. And like I said, no one is better situated to distribute that to their huge base of users and bring those content creators and bring that content over to Threads over time. No reason to think that user behavior can't sort of steadily evolve like that.
And just further along the line of that user behavior, what type of shift do you need to see for Threads to be successful in terms of the number of kind of idols and passive users that are on there? Like Julie, like myself too. I signed up and I put a placeholder thread up there just to say, hey, I'm still trying to figure this thing out. Just give me a little bit while I get my bearings. And I haven't posted anything since. So there are a lot of people that are perhaps just Thread lurkers or Thread passives or idols that they've got to be able to get into that content generation side, which is a very small percentage and base of that millions, tens of millions, 100 million users that they have on there signed up right now, at least.
Yeah. I think there's a critical difference here between how we kind of traditionally think of Twitter. Twitter is obviously, it's a forum, it's a town hall, and all of that. But I think the important part is that Twitter, because of the data and kind of the understanding that Twitter has of its users, which is not that much, honestly. In many cases, there's a lot of anonymous Twitter users. Twitter wasn't very good at targeting and understanding the intent of the users on a commercial basis, right? Meta has all of that. They know a ton about people because of Facebook. They know a ton about people because of Instagram. And oh, by the way, we're now all spending even more time on Instagram because of Reels, right? So Meta can take all of that intelligence and knowledge of what they know about us, and as they see our activity evolve into Threads, they're going to have a tremendously better ability to target people for value and commercial intent on Threads over time.
All right, I'll Threads this interview later. Threads doesn't work as a verb yet. Brad Erickson, RBC Capital Markets Internet Equity Analyst. Good to talk to you. Thank you.
You too. Thanks, guys.
And be sure to stick around for more analysis of Meta's quarter from the horse's mouth, so to speak. Yahoo Finance's Akiko Fujita interviews Meta Chief Financial Officer Susan Li at 3:10 p.m. Eastern today. It's an interview you certainly won't want to miss. Shares of McDonald's, meantime, ticking lower after an initial pop in pre-market trading. McDonald's did report second quarter earnings and beat on the top and bottom line. Revenue boosted by the viral return of the mascot Grimace. But the share's now lower. Here with the numbers and what else is going on. Yahoo Finance reporter Brooke DePalma. So, Brooke, you've been monitoring the conference call. Mm-hmm. Well, is there something that was said on there that maybe is causing the shares to roll over?
Yeah, well, right now, as you noted, shares remain about flat. And right now, both executives, Chris Kempczinski and Ian Borden, the CFO, currently weighing in on macroeconomic challenges that are challenging consumer sentiment, saying that they think a number of our top markets where we know the macroeconomic conditions are challenging. They're saying that they're staying close to consumers. They ultimately look to continue to gain market share as consumers look for value here. But inflation continuing to persist. But despite, what's happening on the call right now, this was a good quarter for McDonald's. The real theme here, as we noted earlier, was that viral campaign around its mascot, Grimace. Of course, they beat on both the top and bottom line. Same-store sales also coming in higher, up 11.7%. Higher than Wall Street estimates of 9.4%. And here in the U.S., they're touting the culturally relevant brand and marketing campaign that really powered these strong results here in the U.S., up 10.3%. But ultimately, the CEO saying on the call that was really a proof point of McDonald's accelerating the Arches 2.0 strategy, that growth strategy, that they're really doubling down on marketing core items as well as delivering digital and driving store growth. Digital sales here growing to $8 billion across its 6 biggest markets. That includes sales of the company-owned and franchise restaurants. And overseas also getting a boost there. We saw overseas and international operating markets, same-store sales rose 11.9%. Now in the UK and Germany, those were driven higher by doubling down on value. Once again, we continue to see a pinched consumer there as inflation continues to take a toll. And overseas in China, really driving international developed markets as well. Sales there rose 14% for those markets overall, but China continuing to double down on efficiency, technology, as well as, progressing out of those COVID-19 lockdowns that were just not too long ago. And so as this call continues, I'm sure we'll hear more about trade down and how exactly they're gaining share from fine dining consumers who are now looking for maybe a McDonald's meal instead.
Yeah, I mean, there have been so many different promotions. You mentioned Grimace. They've had so many collaborations over the years that they've been able to lean into as well. What within the guidance as well are they looking forward to? How are they evaluating the environment with the consumer? As you mentioned, that was brought up on the call, but additionally, just with a different type of consumer too, and their franchisees that they would hope continue to kind of annex themselves to the McDonald's brand and the Golden Arches and open up even more locations too.
Yeah, well, right now, we heard earlier this year that they plan to open 1,900 locations. That was a year-long plan for this year so far. But in addition to that, we continue to hear that margins are significantly weighing on companies, especially overseas, as higher inflation continues to take a toll on franchisees there. In addition to that, the company really doubling down on its chicken menu item. We saw them introduce the chicken sandwich. Now they continue to double down on that. But really, also in addition to that, as we think about the future outlook for McDonald's and store format, the company also giving insight into another store format that they test. They're calling it Cosmix. It's a small format that they said includes all the DNA of McDonald's own unique personality. Of course, we also saw them introduce that digital first location in Fort Worth, Texas earlier this year. And so McDonald's really looking to strategize here, really looking to double down on digital delivery and restaurant growth, and hoping to win again with this marketing game like Grimace.
It's interesting that you mentioned the chicken sandwich and the chicken sandwich wars, because McDonald's CMO and Chief Customer Experience Officer Tariq Hassan had told us recently, just a few weeks back, that the chicken sandwich wars are not done. So it'll be interesting to see how they continue to try and still share in that side of the business as well.
Yeah, and as we heard from Chipotle as well, chicken being a lower cost option there, their chicken outlet store doing well for them. And so McDonald's, hoping to also benefit from that lower price chicken as well.
Yeah, I'm seeing some of the other headlines from the call. By the way, the company says top line growth will moderate later this year. So maybe that's also responsible for some of the decreasing enthusiasm for the shares this morning. Brooke, thank you so much. Appreciate it. Heading into the second quarter earnings season, many analysts were suggesting that any beats would be met with a more muted reaction than last time out. And so far, they weren't wrong. JP Morgan strategists called the reaction worse than typical. Citigroup, Wells Fargo, and Tesla are just some examples of where beating on the bottom line saw shares tick lower. Our next guest says against an uncertain and confusing macro backdrop, investors would be best served by having a broad toolkit that is well diversified among strategies, products, and industries. Joining us now, Seema Shah, Principal Asset Management Chief Global Strategist. So, Seema, what's your read on what we have seen from earnings thus far?
Hi. Well, as you said, I think this earnings season has been fairly strong. You've had a number of beats, but we have to remember that actually coming into the season, there have been a lot of downgrades to the forecast. So the hurdle was fairly low. And I think that's one of the reasons why any company that is beating is not really being celebrated by the market, and any disappointments are really being penalized.
Is there an overwhelming theme of the earnings season? Resiliency was one of the words that we had continued to hear from analysts coming into the start of this season. Now that we're a few weeks in, is there one that's kind of reigning supreme?
Well, I think one of the interesting things for this earnings season is, despite a lot of, growing concerns about the economy, actually, the forward guidance doesn't really mention much concern from that perspective. It's quite optimistic commentary coming out from a lot of these companies, which, in one way, of course, it's very promising. But on the other hand, one of the concerns that many investors have is that there's a lot of complacency in the market. And that's also being added to by this current earnings season. And I think that's one of the reasons why any beats are not getting the same kind of very strong market reaction as usual, because there is concern about complacency.
And so what does one do in reaction to that? You talked about that broad toolkit. What does that mean exactly?
Well, as you said, look, the outlook is fairly unclear. There's a big divide, I think, amongst analysts on the street of whether we're looking at a soft landing, a recession, a no landing, kind of all of these terminologies out there. And with that uncertainty, it does make it quite difficult to have a very clear set for investment perspectives. In that environment, I think the best tool is always going to be diversification across asset classes, across regions. Within the fixed income space, obviously the core fixed income, really the cautious areas, but it's still giving you a bit of pickup. So that's the investment grade area, securitized debt, those are going to perform well. Within equities, given there are some question marks around the US equity market and how much further it can rally from here, it probably makes sense to think about international markets. And from an international market perspective, thinking about which ones are going to be able to buy into some of these long-term themes that are starting to emerge. One of them, for example, being reshoring. And then finally, think about alternatives. That continues to be a really important part of the story. We at Principal Asset Management do think that inflation mitigation continues to be an important part of the portfolio. So from that perspective, thinking about things like infrastructure, which do give you that slight inflation defensiveness, does continue to be a really important part of any portfolio.
Within that broad toolkit as well, how should investors evaluate the state of the consumer right now?
So the consumer is undoubtedly very strong. A lot of the economic data just continues to show that strength, even relative to other sectors. We are a little bit skeptical of how long it can last, however. So on one hand, as we all know, that consumers have really been supported by this huge buildup in excess savings. That is now being wound down. And on some estimates, especially ones that are coming out from the San Francisco Fed, it does suggest that it could be entirely exhausted by the end of this year. So that's a really important support being taken away. And then there's a lot of the pandemic-related fiscal supports, additional ones that have also been protecting consumers and insulating them from monetary policy hikes. That is also starting to fade. So although consumers are very strong today, I guess I'm a little bit cautious of how long that can be sustained.
I feel like we've been cautious of that for a while, Seema. So is there going to be a catalyst, or is it just going to be sort of the gradual deterioration that is flagged by things like the wind down in that excess savings?
Well, you're right. This recession, everyone's been talking about it for months and months, if not quarters. In terms of what's going to be the trigger, I think it can actually be either or. So one of the things that we've generally expected, this is something that which essentially just fades out over time. Those support systems are fading by the end of Q4. They would have faded significantly further. So actually a lot of that economic backdrop has now weakened. On the other hand, once you start to think about earnings and a lot of the complacency, which we do think is built into the system today, that does mean that the market is quite vulnerable to any negative shock. I'll give you one example, which is at the moment with headline inflation in the US down to 3%, there is a general feeling that inflation is now has now been defeated and the Fed has won its task. However, when you start to think about a lot of the climate change issues that we're seeing, the recent spike in commodity prices, I don't think it goes too far to think that actually there could be a threat of a resurgence in inflation around the corner. So there is a lot of uncertainty out there, and that, again, is a reason to have some diversification within your portfolio, focusing on potential growth, but also protecting to the downside if that worst-case scenario does come to fruition.
Seema Shah, stay with us for a hot second here, because after the Fed's much-anticipated rate hike, Chair Powell said they will assess incoming economic data as a whole to make upcoming decisions. Take a listen.
We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks.
So with inflation providing mixed signals, could incoming data be even more important now? Seema Shah, Principal Asset Management Chief Global Strategist, is still with us. So Seema, want to get your reaction first to what Fed Chair Powell said, not only in that clip, but kind of in totality or in whole yesterday, in terms of their pathway forward here and how we might see that continue to show up in some of the key economic data readings.
I mean, the big takeaway from yesterday was really that Powell kept his cards very, very close to his chest. He didn't really reveal anything with regards to forward guidance. And I think that makes sense because they have been reiterating the data dependency of their approach. And between now and September, as he said, there are 2 inflation reports, there are 2 jobs reports, and a huge multitude of economic data, which is really going to shape their decision-making process going forward. So I think all options are on the table. A lot of the GDP data that came out today probably raises the risk of another hike. So we have to just, I guess, continue to watch how that data unfolds from here.
Yeah, I actually thought it was kind of funny during the press conference yesterday, Seema, because the various journalists kept trying to ask him in a lot of different ways, what are you going to do next? And he kept saying, effectively, I don't know what we're going to do next. And nobody wants that answer. Nobody likes that answer, but maybe that's just genuinely the answer. He has no secrets that the rest of us don't have because none of us have the data, right?
Well, exactly. That uncertainty for analysts of what is coming around the corner is shared by the Federal Reserve. And actually, with the ECB, they've just had the decision an hour or so ago. And Christine Lagarde, the ECB president, is repeating a very, very similar line to what we heard from Powell yesterday, which is, this is all dependent on the economic data and how it unfolds. So this isn't actually just a US issue. This is a global issue where we don't really have a very, very strong conviction on where things go from here. So it does make sense for central banks globally to keep all the options on the table. And we may well see another interest rate hike from here. That still is a possibility. But again, it's going to depend on how the growth data is going, how the inflation data is going, as well as, of course, the labor market, which is particularly important.
Yeah, on that front, of course, we did get, it's backward looking, of course, but we did get that better than estimated GDP data. We got durable goods by some measures coming in quite a bit stronger, although those are volatile figures. I'm curious what you're going to continue to pay the most attention to. Is it going to be something like PCE, which the Fed has said it does, or what are your sort of key charts to watch?
So for us, I think the one key thing is going to be anything to do with the labour market, because we have heard from Powell several times the importance of seeing the labour market rebalance, seeing a little bit of softness. He did say yesterday that historically, when interest rates go up, you should typically see some kind of softness from the labour market, which they're yet to see. Do you remember the unemployment rate stands at 3.6%? That is where it was at the beginning of the interest rate tightening cycle last year. So we need to see a bit of that change. If we do see that change coming through, then I think it's fair to say that maybe the Fed has stopped its tightening. It's kind of reached its peak. But if you see the labour market staying as strong as we have seen for the last few months, I think there is still a potential for another rate hike.
We had heard this term growth recession in recent conversations. Is that something that we should be kind of considering even more right now, considering some of the strength in or the labor market where there have been some cracks, but overall the broader trend has still remained intact, or even on the consumer front where there still is this resiliency or this strength within the consumer that's being exhibited?
Yeah, I do think it's a valid outcome that we could expect. So from principal asset management perspective, we are expecting a recession, but it's going to be such a shallow recession in our view. So this is a 1.5% peak to trough decline, incredibly small from a historical perspective. 2 quarters, again, very, very short from a historical perspective. And in that scenario, if you were walking on the street, you wouldn't necessarily know that there's a recession around you. We're only expecting a small increase in the unemployment rate. So that is still that strength factor does come through. It might show up in the data as negative numbers, but actually in terms of the financial market, you may not see meaningful pullbacks, even in a recession outcome.
Very interesting and a good reminder for folks. Seema Shah, Principal Asset Management Chief Global Strategist. Good to catch up with you as always.
Thank you.
We got much more markets action, plus the opening bell coming up. You're watching Yahoo Finance. Mike Wilson of Morgan Stanley has been bearish for quite a long time. And in a note, he just said, we've been wrong. Now, I'm not going to ask you about what he said, but I am curious, like, in a strategy making role, just quickly, how often you sort of re-examine your assumptions?
Constantly. Every single week we meet together as a group and we check in on how our thesis is playing out, new data. The trick is there can be a lot of noise day to day. So really the trick is really figuring out what's the actual signal, what has actually changed, and not getting whipsawed week by week. But indeed, we have gotten new information over the past quarter that has changed the view. The first is the enthusiasm about artificial intelligence and how that's for real and can boost valuations in advance. And then also in terms of the macro picture, we do believe that soft landing odds have risen given the data we've gotten recently.
We just had the opening bell on Wall Street a few minutes ago. Let's do a quick check of the market, sponsored by Tasty Trade. Strong out of the gate here this morning, but in particular, the Dow has now risen, at least right now, it's early yet, 14 straight days, which would be, I think, the first time, right, in its 126-year history that it has done so. We'll see if it hangs on to the gains through day's end, but a lot of that has to do with various Dow components that have reported earnings and have risen in response. But it's not just the Dow that's up today. The NASDAQ is beating it. It has a few companies of its own, Meta, that have reported earnings, and so it's up about 1.4%, and the S&P is somewhere there in the middle. Brad, 14 in a row.
Yeah, where were you when the last time we had a streak like that? If you were around, see your doctor. Dow Jones Industrial Average, you're seeing that up by about 0.25% right now here. So we'll continue to track that as we move on throughout the rest of today's session. See if we can cement that record here. NASDAQ Composite, you're seeing that up ripping to the upside by about 1.5% for the tech-heavy average. And the S&P 500, let's populate this chart here just a little bit more. I need more lines and candlesticks, perhaps. Maybe that'll help you see it at home, folks. There we go. Anyway, past 4 days, up by about 1.5% for the S&P 500. Here today, though, fractional gains up by about 0.9%. Since we mentioned the S&P 500, let's mention 11 sectors here. We won't mention all 11, just the leaders and the laggards here. As you're seeing, pulling up the caboose is industrials. However, we've got more green on the screen, and that's a good thing. XLC, that's the communication services sector here. You're seeing that up by about 3%. We'll dive into some of the catalysts that are driving that. Let's take a look, though, at tech here on the day. Some of the mega cap tech stocks out of the gate this morning on a big week of earnings. We've had already Microsoft and Alphabet and Google, and then additionally you got Meta. Take a look at that. We've been breaking that down for you throughout the morning. That opens higher by about 7.3% right now, a little more than 7%. That's holding on to gains of, and ultimately a lot more green on the screen than there is red for the NASDAQ 100 here right now. Really only that last row basically here in the NASDAQ 100 that's in negative territory. Bringing up the caboose though right now, you've got eBay plus another company we're going to talk about just a little bit later on, Deep Tease. They're seeing eBay down by about 7.5%. We're not really going to talk about that one here today. So we'll get into that just a little bit later in other
Although
hours.
I think that one is also a Dow component, if I'm not mistaken. Honeywell.
eBay?
No, Honeywell.
Oh, Honeywell, yes.
Honeywell, which is
yeah.
down. But otherwise, we're seeing the Dow again up today, despite that stock falling. Enough companies that have reported that are doing better, helping out
Yeah.
the Dow.
Great stuff.
Yeah. All right. Let's talk about some other movers, including Southwest Airlines. The stock is down nearly 9% after Southwest saw revenue drop 10% in the second quarter to $683 million. The low-cost carrier expects airfare costs to rise and revenue per available seat mile to fall in the third quarter as much as 7%. And listen, Southwest's numbers actually met estimates. They were pretty much in line with what analysts had been estimating. But when you're talking about costs going higher, that is not necessarily a good thing. And Southwest it's had a tough year or so, right? Between weather effects, worker effects. So it seems like it's still seeing a little turbulence?
Yeah, they had to acknowledge that, especially given the disruptive weather here. You have a statement out from the execs this morning saying our people delivered a very smooth and reliable operation in the second quarter of 2023, despite disruptive weather. They also operated a record number of flights and carried a record number of customers and bags, all while achieving a completion factor of more than 99%. That, we should note, is their highest they're reporting second quarter performance in the past 10 years. Now, all this considered, you do have the broader sentiment among travelers right now. And this is one of the busier seasons, of course, during the summer here, as you look out to their guidance here and even how they're looking forward to the operations throughout the rest of this summer. For all of the airline operators that are experiencing high volume, it's a question of how they can continue to deliver on that customer experience and ensure that even within some of the high completion rates, that is also coming in tandem with a higher amount of capacity. One of the numbers that jumped out to me was actually the year-over-year expectations. In their 2023 estimation, they were looking for available seat miles year over year. They're actually estimating that to be up 14 to 15%. The previous estimation was no change. And so I think that speaks to some of the capacity that they're bringing back online as well for Southwest.
Right, and they said they're going to raise that capacity going in through the first quarter of next year, and then they're going to start to pull it back. So we'll see how that looks and how that feeds through to the bottom line as they do that, because usually that capacity discipline helps profitability at the airlines. But we'll see what happens this time around.
Indeed.
All right, let's go to another mover. Comcast. The shares are trading higher today by more than 6%, beating Street's expectations. The cable and media company's earnings beat was boosted by Comcast's higher prices, offsetting slowdowns in broadband and the success of its Super Mario Brothers movie. All of that sort of weighing on both ends of the scale for the company. Revenue there up just 1.7%, but it did come in ahead of what analysts had been estimating. Obviously, Comcast, like many of the other media and telecom businesses, is still, it's still coping with subscriber losses, right? So 19,000 subscribers down in its broadband business, and cable TV customers dropping by 543,000. But mobile phone customers are going up. So, it's that's the trend.
Yeah, you know,
You're looking at me quizzically, Brad.
I had only written down 3 words in my notes for
Please.
Comcast: Super Mario Brothers, and I did not. Where have I been? I didn't realize that this movie had done gone gangbusters at the box office here. #1 performer this year.
Peaches,
You saw
peaches,
it?
Peaches, peaches. Yes, there's a song. There's a very catchy Peaches song.
All right, we've played the Barbie
Super Mario
soundtrack on set, so we need to play the Super Mario Brothers soundtrack.
I'll play it during the break. That's a promise to you.
Wonderful.
It wasn't just Super Mario Brothers, though. Peacock actually did pretty well. Added 2 million subscribers in the quarter. Revenue up 85%. Losses from that unit, the company has said, are going to peak this year. So that's what we're, the trajectory of a lot of the newer streaming services: build, and then eventually try to make money from it. So that trajectory seems to be working. Even Super Mario Brothers, though, studio revenue was actually down about 1%.
Yeah.
Even despite the success of that catchy little movie.
I mean, look, I grew up on Mario Party. I still haven't seen the movie, but I need to go. I need to go check it out.
You don't need to go to the theater.
I don't?
You could, but you could also just watch it streaming.
Well, that means I have to create a Peacock login, I guess, or find somebody else's.
I guess so.
They haven't cracked down on password sharing yet, right? I don't know.
I don't think so.
Well, I'll give it a shot. Let's also talk about MasterCard. They came out with their second quarter earnings this morning, reporting a beat on the top and bottom line. MasterCard cited a rise in spending on, get this, travel and entertainment as the catalyst for a boost to profits. Here, take a look at the actuals versus the estimates. We've got them loaded up for you on your screen. Beat on both the top and bottom lines, as we mentioned there. And, even as you're kind of looking through the results here from MasterCard, it should come as no surprise that they're saying that travel, and if that is any indicator about still how much legs there is to this boom in travel, and how even some of the executives that have been talking about it, we heard from Hilton earlier this week as well. They just reported yesterday. We've been able to speak to the airline CEOs, a few of them, over the course of this earnings period, who time and time again continue to say that travel is strong, and we continue to scratch our heads and ask, well, how long can it be strong for? Well, you can look to data like MasterCard is putting out to really get a sense of how much those spends and the swipes or the card not present payments are contributing to this strong demand, because these are customers that are not just purchasing during that quarter, but also even for trips that are going to take place from quarters from now as well. And so that's something to continue to kind of look through the card and transactions processors to get a signal of what that strength in travel and entertainment looks like too.
Yeah, so you had 3 words for me with Comcast. I have one number for you with MasterCard, and that's 154%. Michael Miebach, who is the CEO, said of MasterCard, spending tied to overseas travel in particular is at 154% of pre-pandemic levels, which is pretty incredible. It's the Carpe Diem trade. The Carpe Diem, if not now, then when?
Right.
Latin.
It's Latin? Oh, man. See, I went to France, and I think I know French now.
Did you never see Dead Poets Society?
No, I haven't yet.
Put it on your list.
I need to. Will do.
Over Super Mario Brothers.
Done deal. All right. Maybe I'll find them both on streaming and borrow somebody's account. Also, everyone, we've got more markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
The Dow is on track for a new record as a 14th consecutive day of gains would set up the longest winning streak in 136 years. Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange. Jared, all right, help us break down the significance of this milestone. Should we hit it at 4 o'clock today?
Well, I'll tell you what, with a sample size of 0 now, or I'm actually going to correct that in a second, I'm not going to get too excited about it because anything that small doesn't really have any kind of predictive power. If anything, it says the market might be a little overstretched right now, but I did do some research where I showed earlier in the week, not going to repeat it, that strength tends to beget strength. So if you have these big streaks like 10, 12, even 15 days, you might have a short-term pullback, but in the long run, tends to be up 6 months, a year from now. With respect to 14 days, now there was an instance, I found somebody else on Twitter, Charlie Bileo, and he was able to find a 14 streak back in 1897. Something a little bit different back then was they had Saturday trading, so that adds a little wrinkle. That was in place until 1952. So unless you have really good data sources that include that Saturday trading, you're probably going to miss it. I checked mine, I don't have it, so I'm gonna have to take their word for it. My streak days before 1952 probably over right now. Let me move on and let's tackle the Wi-Fi Interactive because I just wanna show you some seasonality with respect to Fed Day. First of all, note that all the indices on the left, except for the Toronto Exchange, in the green. And here we have seasonality around these FOMC days. This goes all the way back to 2018, and that's when Powell became chair of the FOMC. And I've divided the time periods into pre-Fed Day gaps, so that's already passed. Fed Day, that's yesterday till 2 p.m. That's right here. When they start getting red, that's yesterday, 2 p.m. until the close. And we didn't see much happen yesterday. We did get a mixed market, I believe. But the real downer has been post-Fed Day. Although it's ticked up this year on a few different days, net, that has been the worst time to be long in the market. So just throwing that out there, I think that's a mild seasonality play. I do want to get into the market breadth because the concentration argument continues to get kind of destroyed the way we're looking at in the market. Let me take a look at a 1-month view of the sector action. We can see energy, financials, communication services, and real estate are all outperforming. That's a pretty healthy mix, but skewed to the value and the cyclical side. And then you take a look at the leaders, might be surprised to see that over the last month, regional banks are my #1 leader, followed by meme stocks. Then you got ARK, and then you got IPOs. All the way at the bottom, the only thing in red is crypto. So whatever linkage crypto had with the Fed and with stocks and risk markets in general seems to be broken right now. But the bottom line is this rally continues to gather steam and continues to gather breadth. And so it's difficult to come up with bearish arguments until price convinces us otherwise. And that's what price has to do.
Well, we'll see if it does. All right, thanks so much, Jared. Appreciate all of that important context.
As he always does.
As he always does. Investors aren't eating up Chipotle's earnings report this quarter as the stock is down 8.5%. The restaurant chain saw same-store sales rise 7.4% from a year ago, but that was below the average analyst estimate of closer to 7.7%. Chipotle did get a boost from prior price increases with food, beverages, and packaging costs making up nearly 30% of its revenue. Chipotle CFO Jack Hartung is joining us now. Jack, it's great to see you as always here. I mean, 7.4% anywhere else would certainly be a victory. That's still big growth that you guys are seeing here. What do you feel like, if anything, didn't go right in the quarter, or do you think that the street is not getting it right?
Yeah, listen, we're really proud of the results in the quarter. We had, as you mentioned, strong comp at 7.4%. That was driven by over 4% transactions. Our margins were the highest margin we've had since 2015, and so we're really proud about that. And more importantly, we're setting ourselves up for future growth, not just in the U.S., but in international as well. We're investing in robotics. So we're really bullish about where we stand today and where we go in the future. Our stock has performed really well this year. And, it's still, even with this pullback, is up, around 35, 36%. So this might be one of those cases, Julie, where the stock just got ahead of itself. And, we don't think about our business or our stock in terms of a day or a week. That we think about it in terms of next year, the next 5 years, the next 10. And so we don't worry about short-term moves like this.
One of the things, Jack, that your competitor, one of them, of many, of course, internationally, was talking about on their earnings call this morning was a change in consumer sentiment. Is that anywhere present, either in the results or even in your outlook right now, as you think about the different touch points that you have with so many different diners?
Yeah, we're not seeing it. Most of our business is in the U.S. And in the U.S., we look at our customers, not just overall, but we break it down by income levels. Last year, we did see the lower income consumer was pulling back a little bit, but they've come back and they're spending at just about the same rate as our higher income consumers. And in our case, I think what Chipotle offers to customers, both at the low income, the medium, and the high income, is that we're the kind of food that they want to eat. It's wholesome ingredients, sustainably raised ingredients. It's real cooking. It's food that they crave. And it's a lot of food for a very, very good value. So an environment like this, Chipotle is a great place for consumers of all spending abilities to join. And, if you're going to pull back on your budget, Chipotle's not, it's very affordable. So it's not something you have to pull back on.
Talk to us about the trends you're seeing then in terms of frequency of visits, in terms of size of ticket, for example, sort of related to what you were just talking about.
Yeah, we're not seeing any change in sides whatsoever. So the attachment of guac and queso and chips and salsa and things like that are very, very consistent. The only thing we're seeing that is affecting our check is the group size is getting smaller. But that's really a continued return from this post-pandemic period. We're seeing that our urban restaurants are outcomping our suburban restaurants. That means obviously more folks are working from the office from home. And so instead of getting a meal with your family at home while you're working, you're at the office and you're getting it by yourself. So we're seeing a normalization of group size. Now, our group size today is still higher than it was in 2019. So we're, I would say, getting back to normal, but no indication that people are trying to spend less when they visit Chipotle.
And so all that considered, there have been some significant digital investments that the company has made that you continue to make and menu innovation kind of in tandem with that. Where is the biggest pickup that you're seeing right now in menu innovation and what's on the docket next?
Yeah, so Chicken al Pastor has been fantastic. 1 in 5 customers is getting Chicken al Pastor. The beauty about Chicken al Pastor is from an execution standpoint in the restaurants, it's very seamless. It's the same chicken that we serve normally, but it's got a different marinade, a very delicious, slightly spicy marinade with a little pineapple, a little pepper. So it's really, really delicious. So it's easy for our teams to execute. Our customers love it. It's been really our most successful LTO. We do have another LTO coming in the fall. Now, we haven't announced it yet, so I'm going to have to tease you a little bit. I can tell you it's not chicken and it's not brisket, but we're really excited about what's to come. And menu innovation is important because customers know that they can get real culinary, real cooking at Chipotle. And for us to have some exciting news just a couple times a year, we think is important to keep our customers excited about visiting and getting some variety.
Let the guessing begin. Not chicken, not beef. There are some other proteins. All right, Jack, we'll have to keep in touch with you on that one. Let's talk pricing for a moment. Where do you guys stand in the pricing cycle? I think the last time we spoke to you, you were definitely slowing down price increases. And on a related note, if I can also get you to comment on portion size, if you guys have decreased portion size as well.
Yeah, on pricing, we're coming on a year since we've had, our last national price action. That was in early October of last year. So we've held the line on pricing this year, and we've still been able to generate these, very, very strong margins. We have seen a little bit of inflation in some of our ingredients. You haven't seen it in our margins yet because we've had favorable avocado prices that have offset it. And also the idea of Chicken al Pastor, we actually are shifting some meat eaters, which is more expensive from a food cost and a margin standpoint, into chicken, which is more favorable from a margin standpoint. And as those things normalize, some of this inflation will come through. So we have talked about, we'll consider whether we need to take a modest pricing action later in the year. Portion sizes are not getting smaller. When customers come to Chipotle, they expect their burrito. They want not only the ingredients they want, but they want the portions that they want. One of the great things about customers that come to our restaurant, they interact with our customers. They get exactly what they want, as they move down the line. And from a digital standpoint, it's the same thing. You can order light rice if you want, or you can get extra rice if you want. And you can do that throughout each of our ingredients along the way. So we're not going to try to manage our margins based on portion size.
Jack, want to go to kind of a holistic Earth type of perspective here, as we've already heard so much about scientists saying that this is going to be one of the hottest years on record. And when you think about that, As it relates to Chipotle, I think about sourcing. I mean, you're one of those companies that has been more vocal about the sustainability of your practices and getting ingredients and working with farmers to get more kind of farm to table or farm to burrito or farm to bowl, whatever that may look like. So do you look at some of the climate risks and factor that into how Chipotle is sourcing ingredients and continuously able to get them into the most kind of fresh environments to then be able to serve them up to customers? How do you kind of look at that as a broader put or something that you have to navigate?
Yeah. Listen, we do, and I wouldn't say it's necessarily just based on climate or based on the heat wave that we're seeing right now. It's really based on diversifying where we get our ingredients from. For example, we buy a lot of local produce, anywhere between 35 and 40 million pounds per year. That's important for us to diversify where we're buying from. It's also important for our customers to know that the produce in your bowl today, was raised within a short distance of where the restaurant is. That's very, very important. It also supports local farmers when we do things like that. But then even beyond that, like avocados, for example, we've been diversifying where we buy our avocados from. So we buy from California and Mexico, and we've done that for a couple of decades now. But we're diversifying by looking in areas like South America, for example. And so we're working with suppliers that haven't been big sources of avocados in the past, but we'll partner with them because they know that we have the demand. And if we have the demand and we have an agreement with them, they can invest in building that capacity over time. So it's one of the areas where we're thinking about not just this year or next year, over the next 10 years, where our ingredients going to come from. And let's diversify from a supplier standpoint and from a geography standpoint. And then we'll be able to keep up with the significant growth ahead of us.
Jack, sort of on a related note, it's interesting. As Brad was asking that question, I got a news headline alert on my phone talking about July being Earth's hottest month on record. So, obviously this is a very pertinent conversation right now. I'm curious how, not just with produce, but all across the board, it affects your cost structure and how you think about that going forward, because obviously energy costs are a factor here as well when you have not just heat, but other kinds of weather events, not just for avocados, but really products across the board, right? I would imagine you would continue to see a longer term secular upward pressure on some of this produce. How do you think about all of that?
Well, there's one direct effect. Frankly, we're seeing our utility costs up. We signaled that in the third quarter that our utility costs will be up. And also, when you have this kind of heat and you're putting this much pressure on your HVAC, you have breakdowns as well. So our M&R is a little higher as well. From a produce standpoint, from an ingredient standpoint, again, we don't know where the climate challenges are going to be. And sometimes it's, storms in a certain area of the country, or it could be heat in a certain area of the country. And so the best thing we can do is we partner, and we have long-term partnerships with our folks. Our partners know they can invest in their business, whether it's to expand capacity, whether it's to bring new technology so they can deal with some of these weather challenges. We also have the Cultivate Next Fund, which is a fund where we are working with, really early startup companies to figure out how can you diversify where and how crops are grown. So that, again, you can diversify and not be tied to just one geography. If one geography gets hit by a weather event, whether it's a short term or a longer term, it's very difficult to source the fresh ingredients that we need to prepare our meals at Chipotle. So this idea of partnering over a long period of time, so we can diversify and figure out what technology we can use to think about not just today but years into the future is very important to us.
Jack, thanks so much. I mean, I'm just blown away by our conversations quarter after quarter, and we appreciate you taking the time, as always. Chipotle CFO Jack Hartung, really appreciate the time.
Thank you, guys.
Definitely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
At the end of this earnings season, will stocks be higher or lower?
Well, the short answer is I don't know. I don't think anybody does. But I think that if you don't get the similar pattern that you saw in Q1, where the bar was lowered so much, then it was just easy to step over for pretty much every company, then you had this pretty miraculous rebound into flat territory, which is impressive when you go from down 5% to no growth, that climb upwards. And I think actually that had that was a big part of why the rally kind of persisted throughout the second quarter. So if you don't get that and you actually get cuts to guidance, which we've already started to see for the rest of the year, my guess would be you probably have some more stumbling amongst the bigger companies and the more high-profile names.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We are about 30 minutes into the trading day here, and let's take a look at how stocks are moving right now. First and foremost, Wall Street taking yesterday's quarter basis point rate hike as the Fed's last, sending stocks higher. Markets also feeling the impact of results season. Meta surging on second quarter results. A different story over at Chipotle and McDonald's, though.
Looking at other individual stocks on the move, Crocs falling today after reporting a record high revenue in its second quarter, $1.07 billion. The footwear brand also beat on adjusted earnings per share, up 11% to $3.59, where $3.59, where analysts expected a decline in earnings in the quarter. But the company did see a slowdown in its Hey Dudes brand. Its wholesale revenue declined in the second quarter. That could be weighing on investor sentiment.
And AbbVie is climbing this morning. The company beating street expectations for second quarter earnings, driven by a lower than expected fall in sales of its arthritis drug, Humira. Global Humira sales fell over 25% to $4.01 billion. That's just above analyst expectations of $3.94 billion in sales. The company also released its annual profit forecast and raised that as the pharmaceutical giant and company sees sales growth in its newer drugs.
And speaking of drug makers, Bristol Myers Squibb also falling today after reporting a miss on revenue and earnings per share in its second quarter. Also, it slashed its full-year outlook, driven by a dip in sales for two of its top drugs, blood cancer treatment Revlimid and blood thinner Eliquis, which are facing generic competition. The company is also citing an increase in patients receiving its cancer drugs for free from its Patient Assistance Foundation as a blow to sales.
Shares of ServiceNow, they are also on the move this morning as the enterprise software company reported second quarter earnings after the bell yesterday, beating analyst expectations on the top and bottom line. Revenue came in at $2.15 billion. Street was expecting $2.13 billion. That's a beat. And diluted earnings per share, that was $2.37 versus the $2.05 expected. The company also announcing a new strategic partnership with NVIDIA and Accenture. Joining us now to help us break all of this down, we've got Bill McDermott, ServiceNow CEO. Bill, always a pleasure to speak with you and get some of the insights from the quarter, perhaps as well, some of the outlook coming off of a partnership like this with NVIDIA. How did that come to be, and what are you expecting that to do in terms of delivering some future type of financial performance to the business as well?
Well, thank you for having me, Brad. Yeah, we announced a ServiceNow AI Lighthouse customer program where we're co-developing with NVIDIA. So NVIDIA on the generative AI tech stack, ServiceNow on the workflow automation, and Accenture on the services and implementation for the most significant brands in the world to really take AI and transform their business. And if you think about each of these industries, they all have something a little bit different about them. Insurance, for example, might be looking to use AI-based decision-making to reinvent the underwriting process. Or you could have manufacturing where they're trying to automate the shop floor or supplier onboarding to reinvent the supply chains. And then, just think about healthcare and big pharma. Obviously, everybody wants to give the patient a better experience, and you have to put natural language knowledge support in front of the clinicians so they can care for the patient instead of keyboarding stuff into a computer. So all these industries are going to be completely reinvented with the power of generative AI, and ServiceNow is the first mover in enterprise software to bring a platform to market that does just that.
So you mentioned a couple of examples of how this would work, Bill. Hey, it's Julie. It's good to see you.
Hi, Julie.
Hi. How quickly do you expect this to be implemented? Talk to me about what you're hearing from customers and how soon they want this product.
Yeah, it's a great question, Julie, because we, as you know, have had AI in the ServiceNow platform for years now. We were the first to do that in an enterprise software platform for the enterprise. So whatever the function is, whether it's IT or you're taking better care of your employees or caring for your customers, or even taking your innovative developers and giving them the opportunity to text to code or text to a workflow or text to new application development, we've been doing that. And that business where we have AI-infused innovation in our platform is growing well over 50% on a year-over-year basis. And that is in our current results and our current forecast. The big upside, though, are these transformative Gen AI use cases where we're specifically innovating on the ServiceNow platform to do very big and transformational things. Is that going to be 2, 3, or 4 months? Will we see those results more in 2024 than 2023? That still remains to be seen. But what I can tell you is there's 125 of the world's largest brands in multiple industries lined up to participate in this program because the CEOs and the C-suite executives want to go forward on a Gen AI basis. And what's happening and why they're so excited is the enterprise data is their data. So you don't have the hallucination challenges of the open internet. And we're really working with their data to do highly transformative things. So I think it's going to happen pretty quick. And that's why we have such a bull case in mind for ServiceNow going forward.
I mean, it is interesting, though, as you said, that you didn't incorporate this into the forecast as of yet. Are you worried at all? I know we've talked about this before, about the spending cycle on the part of clients. You know, we're going into a period where I know we've been predicting an economic slowdown for a while now that hasn't quite materialized, but what are you seeing from your perspective, and why didn't you sort of bake this more into your forecast?
Well, there's a couple things. One, if you think about the IT budgeting cycle for major corporations, they tend to do it on an annual basis. So big innovation like this is now coming in essentially the third quarter of an annual budget cycle. So I think you're going to see many more companies plan for large transformative Gen AI projects to take place in 2024. Having said that, the business cases for these Gen AI opportunities in terms of taking cost out, bringing productivity in, or going after growth are so significant that, to me, it's going to be hard for companies to refuse them or even delay them, but that still remains to be seen. And that's why we gave a beat and raise quarter, as has become a habit here, knock on wood, and also a very strong guide where we upped the guidance, but we didn't completely implement all of the expectations for this bull case on Gen AI until it actually begins happening. And I think that's just prudent guidance.
How do you ensure that generative AI doesn't cannibalize other parts of the business going forward too?
Wonderful, wonderful point. So Brad, here's how that one works. We have pro pricing built into our platform for all the existing AI cases we already have. You have to have the pro version of the ServiceNow platform. And the generative AI transformational results and solutions will be something we're calling Pro Plus. And they will be additive to the pricing methodology for ServiceNow because, again, the benefit that the customer will get is so big. And the benefit that ServiceNow will get is a fraction of the value that we add to the customer relationship. But it is an uplift in the pricing structure of the company. And that is why the flywheel for innovation at ServiceNow is so important to us, because the customer gets the big benefit, we get a fraction of it, but obviously that helps our company continue to be the defining enterprise software company of the 21st century.
Bill, looking at some of the customer data from the quarter, customers with more than $1 million in annual contract value up 18%, although that is a bit of a slowdown. Going forward with a lot of the expansion in abilities of some of these products you're talking about, do you expect your growth to come from a higher number of customers or existing customers spending more with ServiceNow?
We're getting a lot of net new logos, Julie, where companies that were not initiated on the ServiceNow brand have heard about ServiceNow, and they haven't heard anything but good things about ServiceNow because all of our customers love us. And that's very unique. You don't hear that very often about enterprise software companies. If you look at our top 20 deals in the quarter, 19 of those top 20 deals had 5 or more products in the bill of materials that the customer signed up for. We had 9 customers sign up for 10 or more products. And our deals that are greater than 20 million in average or annual contract value are up 55% on a year-over-year basis. So what you're seeing is an insatiable appetite for the ServiceNow platform for new customers, and then the existing customers we have the highest retention rate in the enterprise software industry at 99+%, and we have a very aggressive customer base that generally grows 25-30% on a year-over-year basis by expanding their use of the ServiceNow platform. And what you see with ServiceNow is an intelligent platform for end-to-end digital transformation across the entire enterprise. We reinvent IT. We give you a better employee experience. We take care of your customer and how you service your customer in the front, mid, and back office. And ultimately, we galvanize the innovation your engineers and innovators are able to deliver for your customers. And that really is the perfect recipe for a growth company in software.
Bill, just lastly here, you perhaps for our viewers, a gauge of how confident businesses and their CEOs, their leaders, and even kind of their kind of cost structures are right now, is to know how long some of these deals are being netted for. Because when businesses are confident, they're coming to you, like they're coming to ServiceNow and saying, hey, we're comfortable in having an extended term deal. Are you seeing any moderation in the length or the extent of deals that you're seeing come through right now?
And if anything, our customers want to do bigger deals over longer periods of time because they really want to be locked and loaded on the roadmap of ServiceNow, so they get a peek behind the curtain on where we're taking the innovation cycle so they can plan for it. And I think that's a super, super encouraging sign. I was the guy that said there's no chance in 2023 that IT budgets would be cut. That's a fact. I'm also the guy that's saying the IT strategy has become the business strategy, and I do expect a large tailwind of investment going into the generative AI area. And I'm unaware of a single CEO that I have met that hasn't said full speed ahead on Gen AI. And I expect my full management team, based on their position in the company, to adopt use cases that are AI-driven, that can take cost out, improve productivity, or get me to a higher rate of growth. Every C-level executive is on this one, which is why I personally believe this is an iPhone moment for enterprise software. And if you have first mover advantage like we do with Gen AI, and you have amazing partners like we do, in the case of NVIDIA and Accenture and many more, I'm just super proud of the NVIDIA partnership with Jensen, because not only is he a great friend, but he's running really one of the greatest companies of all time, thanks to his personal domain expertise and leadership. And it's just an encouraging sign to see somebody like that lean all in with ServiceNow in the belief that we have the platform to solve this generation's biggest opportunities and biggest challenges. And that's what we're going after. We really think we can lift the world GDP by $7 trillion over the next 10 years. And ServiceNow, NVIDIA, Accenture, and others will have a big hand in doing that.
Yeah, and Jensen has also talked about this being an iPhone moment. So you guys are on the same page in more ways than one. Bill McDermott, good to see you. ServiceNow CEO, appreciate it.
Thank you, Julie and Brad.
Take care. All your markets action coming up. You're watching Yahoo Finance. Does anyone really understand AI?
Well, I'm sure there are experts who do, maybe the ones who are kind of building out the infrastructure. I actually think the whole concept of AI might be overly simplified. And I think there are so many different avenues you can go. Much like the internet, everybody compares it to 20 years ago. Look how many use cases there are for it, and there have been, and then the technologies that have kind of spurred from that. So I think the mistake would be to assume it's just this one monolith that we can kind of, copy paste onto everything as a descriptor. There's probably a lot more that comes from it in different industries. And one of the reasons that I don't think AI is just a tech play, I think it's many sectors, actually the beneficiaries of it, that might end up doing a lot better because they can kind of, right-size businesses that way.
We got a quick check of the markets for you, sponsored by Tasty. Trade all three major averages up, as we've been discussing. The Dow up for the 14th straight session, if it makes it through the close on the plus side. The S&P up about 2/3. The Nasdaq up 1.25%. All of this driven by earnings, and in particular Meta boosting the Nasdaq. Well, last weekend kicked off the movie event of the summer. We're talking about Barbenheimer, the debut of Barbie and Oppenheimer, bringing millions of moviegoers to theaters. Greta Gerwig's directed blockbuster, backed by both Mattel and Warner Brothers, collected another $182 million from 69 overseas markets, bringing its global total to $337 million. And Oppenheimer brought in another about $93 million from 78 international territories, resulting in a $174.2 million global haul. Christopher Nolan's fans traveled far and wide to a select few IMAX theaters to see Oppenheimer in its intended 70mm film format. For more on the film and entertainment industry, we're joined by Richard Gelfond, Chief Executive Officer of IMAX Corporation. Our Ali Canal is with us as well. You guys also reported earnings that got a boost from Oppenheimer, which was really interesting. Richard, talk to us about how the year has gone and sort of then Oppenheimer, really being successful for you all.
So the earnings haven't yet got a boost from Oppenheimer.
Right. But you talked a lot on the call about how big it was for you all.
We did, and the narrative is our first quarter was really good. Yesterday we reported our second quarter, and we beat pretty much all the key indexes by about 30%. And the reason for that is there's been a paradigm shift. So our market share in North America is up 50% from pre-pandemic, and globally it's up very, very strong as well. When people go out, they know they want something really different than their couches. They had enough of that, and they're willing to pay for it. So as a result, our box office is tracking towards 2019 pre-pandemic levels, and other areas of our business like signings and installs are also doing very well, which lead to network growth. Oppenheimer has made this already the biggest July in IMAX's history. And we're over $50 million for the first 4 days just in IMAX. And remember, we're less than 1% of the screen showing it. So obviously that bodes very well for the third quarter right now. So the year is set up nicely. Our stock is up very big today. And I think it's a matter of taking out your pen and adding up the numbers for the first 2 quarters, third quarter, look at what a fair multiple is. And we've been very undervalued, but I hope now is the turning point for that.
Richard, I want to talk about China because we've seen some softness in that market. Mission Impossible 7, for example, those movies typically do very well in China, but not so much this time around. It seems like Chinese moviegoers, they want more local language titles. Given how global your business is that a concern at all?
Yeah, I mean, you're right. The Hollywood films have not done as well as they have in previous years. The good news for IMAX is we've really over-indexed. So whereas we used to do for US films about 10% of the Chinese box office, now we're doing 15, 20% of the Chinese box office. So part of the narrative I was just talking about, gaining market share, has insulated from some of that, not all of it. The rest of it, though, that's really helped us is local language films. So we pivoted several years ago to where, I don't know, around half of our slate there are Chinese films. And there was a film this weekend called Creation of the Gods, a Chinese language film. And we did about 16% of the Chinese box office on IMAX screens, 1% of the total. So, you know, again, this whole shift I've been talking about has really buffeted us against some of those changes. But I think what's going on in China is, you know, it seems like so long ago, COVID, but in China, they just lifted the quarantine in December. So if you look at the rest of the world, we've been out of it for like 2 years. China's been out of it only for 6 or 7 months. So it's coming back, it's just taking a little more time.
When you think about the number of new screens that you're trying to get into for IMAX, I mean, you've already got your baseline that you've communicated to the street. What would really look like the marker of success if you were able to expand here in the U.S., but also internationally as well?
Well, I think the marker of success is what we announced yesterday. We're up to 85 new signings, and 80% of those are new theaters, and they're in every region of the world: China, the U.S., Canada, Europe. But we announced we're at about 85 signings so far. And last year, for the whole year, we did 47. So we're at 85 and halfway through it. So we've seen real demand from our exhibition partners. Again, our model is we license our technology, and they've seen the results. And you know, when you look at a movie like Oppenheimer or Avatar or Guardians of the Galaxy or the Chinese local language movies this year, I mean, the model's really attractive for them. And they're stepping up and they're signing up to expand their IMAX network.
I'm pretty excited for the Marvels, I have to say, on that front. Richard, our executive editor, Brian Sozzi, had the chance to talk with the CEO of Mattel. And I know I know Barbie's not in IMAX theaters, but I want to play what he had to say about the success of that franchise. And then I want to ask you something about it. So just hang on a second.
Sure.
This movie is really a showcase for the cultural resonance of our brands, our ability to attract and collaborate with top talent, and very importantly, our capabilities to take our brands and elevate them to create cultural moments. It speaks to the potential of Mattel Films and the significant progress we made on our strategy to capture the full value of our IP. So it is an important moment for Barbie. It's a milestone moment for Mattel.
Now, as you look at that upcoming slate that he talks about, you know, the Barbie is just the beginning. Is that good news for you guys as well as you look at that film slate, as you look at other upcoming films? I mean, Barbie's not an action film, but Hot Wheels presumably will be more of one, might be a better fit for IMAX. How are you thinking about that?
Well, I think the more content from whatever its source, the better for us. And I think particularly, as you would guess, visually exciting content or things where audio really adds a lot, or filmmakers doing different things. And you know, I agree with his take, but I rotate it a little bit. I think it also has to do with great filmmakers, and I think it has to do with original IP. I mean, clearly the market is telling us that more of the same isn't going to continue to deliver more of the same results. Sequels and franchises have done okay, but back to the question earlier, there's been a little fatigue around it. I think it's been a little bit exaggerated, but I also think the other part is a new way of marketing. So I have to give Warner Brothers credit, the way they marketed Barbie, because it wasn't a franchise. They had to be original about it, and it was fantastic. The pink house in Malibu and all kinds of crazy things. And I'd say the same thing about Oppenheimer. I mean, I don't know if you've seen the movie or not, but it's about a lot of things, not just the Manhattan Project. And I think Universal did a phenomenal job in playing off of Chris Nolan's reputation, playing off the IMAX of all of it and how that made it special, and also the plot. So I think this original IP leads to original marketing, and the combination of the two, I think, is what led to this amazing past weekend.
Richard, the overhang of all of this is the double strike in Hollywood. You said on the earnings call that you don't believe the film slate in the back half of the year will be adjusted to account for the strike, but we have seen reports that that is being considered from Disney, Warner Brothers Discovery. What's the damage that could potentially happen if those studios start to shift those schedules, and how are you safeguarding your business for that? Well,
fortunately, one of the films is Dune, which is playing pretty much at the same time as your favorite film, Marvel's. So, if for some reason that moved, we could pivot to other films. Remember, we're not tied to one movie. We have flexibility. Also, for this year in the first quarter, 30% of our films were local language films, 30% of our box office. Second quarter, 20% of our box office. So we could also pivot to local language films. And Japanese anime is a great example. We play that not only in Japan, but it's popular all over the world. But to your premise, I think it's very unlikely that the films the remainder of the year move. They're already, all the films we're doing are already in the can, they're done. So you don't need the talent to really get the films finished. What you need the talent for is to promote it. And I think when they do the math on delaying them, they'd have the carrying costs on the film for another year, and with interest rates where they are now, that's not insignificant. They've also launched their marketing campaigns. So I think about Dune, for example, it's supposed to be phenomenal. The trailers are out, the interest is built. If you pulled that back and you had to relaunch it a year from now, and who knows what it's in competition with, that would be a very difficult environment. And then there's the IMAX of it all. Again, you look at the box office that we did for Oppenheimer, and I would think the studios are not going to want to miss out on that. And I don't know whether we're going to be able to have an IMAX run for whenever they move it to.
Right.
So as you said, it's possible, but I think the odds are slim that that'll move.
That's a really helpful breakdown of all of the factors behind all of this. Thank you so much, Richard. Really appreciate your time today.
Thank you. I appreciate all of you
coming.
coming.
Yeah, good to see you.
Take care.
Richard Gelfond, IMAX CEO, and our Ali Canal. Well, U.S. regulators have released a long-awaited proposal that would see the biggest banks boost their capital requirements. The measures, released by the Federal Reserve and FDIC, would boost those requirements for banks with at least $100 billion in assets by an estimated 16%. Yahoo Finance's David Hollerith has the details. David, talk us through this.
Yeah, it's a sweeping proposal we're looking at right now, more than 1,000 pages. In aggregate, 16% increase to bank capital requirements, and these are for the large banks. Importantly, a lot of this is based off of the international Basel standards and have been interpreted by U.S. regulators. Newer things that have been added in include taking these requirements and sort of extending it to all banks above $100 billion in assets. So that sort of widens what has been a long-awaited regulatory change to something that's more of a reflection of things that have happened this year. Also importantly, the unrealized losses for available for sale securities, which previously had been something that banks didn't have to account for, has been changed. So now that is a part of something that banks do have to account for. At a high level, though, this impacts the most the giants of the industry. That's those with large trading desks and also just coast-to-coast bank franchises. their capital requirements are expected to rise 19% on average. For the smaller, I say smaller, but the banks with 250 billion assets or more, they're going to see their average capital requirements rise by about 10%. And then the smallest of this group, those between 100 and 250 billion in assets, will see their capital requirements rise about 5% on average. So officials have argued that the changes are needed to improve the resilience and to better prepare banks for future losses. And that's what this is all about. Again, the changes are going to affect the largest banks, but the new thing here, and it has a lot to do with what's happened over the past year, is that it's going to incorporate the smaller, larger banks, I guess we would say, which looks roughly like the top 30 at this point. Now, there's going to be a phase-in period, and banks are expected to be able to comment for the next 120 days on this, and we're sure to hear some feedback from what they think of the new rules. But in general, we're looking at sort of a July 2025 period to begin these new rules to phase in for the banks. And then after that, sort of they will become official in 2028, July 2028, excuse me.
All right, we're going to be tracking closely that timeline there. David, thanks so much. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
As central banks raise rates to keep a lid on inflation, the Fed yesterday, the ECB most recently today, one word does keep popping up, and that is diversification. We often talk about investors needing a more sophisticated toolkit, but what should go in there? What are the tools? For many investors, one place to look is real estate, considered by many as the ultimate asset, alternative or otherwise. And REITs, or real estate investment trusts, are one way to play the space. Blackstone, a major figure in that sector, its privately held BREIT has a net asset value of $68 billion, which much of its exposure in rental housing, industrial, and data centers. Joining us now is Joan Solotar, Blackstone Global Head of Private Wealth Solutions. BREIT is under that, but there's much more in your purview. Thank you so much for being being here, Joan. We
Thank
appreciate
you for
it.
having me.
So let's talk about real estate right now and how investors should be thinking about it in their portfolios, right? Because we're sort of at a delicate moment, if you will, in the market. So how are you talking to people about it?
So I'll talk about real estate specifically, but I think just thinking about portfolios, if you go back a little bit in time, you don't have to go back too far, the 60-40, 60% stocks, 40% fixed income was the mantra. Performed pretty terribly a couple of years ago, and I think that really just accelerated conversation. But today, individuals are looking to invest a lot more like institutions are, so having core allocations in areas like real estate. And there's a lot of news, noise, and actual fundamentals that are pretty negative in certain parts of real estate. But you have to differentiate where you invest matters. And if you think about the goal of any investment, it's to have cash in your pocket and appreciation, and that is what real estate provides.
So give us both sides of the trade there. What are the brightest spots to be looking at right now, and what are the areas within real estate that are getting kind of investor chagrin and reasonably so?
Yes. So the most challenged today are traditional offices. Think about New York, San Francisco, high vacancy rates and the like, or retail because of the very long tail trend of e-commerce. So those I would put in the negative category. They will be challenged for some time to come. And then on the other side, think about short supply, very high demand in areas like warehouses, which has been driven by e-commerce over a long period of time, rental housing, shortage in building. There's just been this major gap really since the global financial crisis that we haven't been able to narrow, and data centers, which I think we're going to be talking about for at least the next decade. I know you've been focused on AI on your show very recently, and that is what's driving demand, and it has just exploded. And it is costly to build. You need land, connectivity to electricity, power, and the like. And so vacancy rates there are just minuscule.
Compared to a lot of other parts of the industry.
Correct.
So do you expect we showed sort of the breakdown of that BREIT portfolio. Do you expect the proportion of things like data centers to climb?
I do. We are fortunate in that we have built out this platform. You mentioned $68 billion. We have a lot of capital that we can deploy. We have quite a lot of land bank that's connected to power. And you are just seeing demand for that exploding. So this is something you will hear much more about from us over time as those get built out. And I think the other piece of it is that unlike development, when you think about development of apartments or development of office, which is speculative, these are built to suit. So you already know who the tenant is, it's contracted for, so very strong cash flow.
Now, you guys made some news earlier this year. You did limit investor withdrawals from BREIT, which is in your purview to do so. Talk to me about the rationale behind that and how long you expect to do that.
Yeah, it's a great question. You know, when you're buying stocks and bonds, you can trade those on a daily basis. When you're choosing private investments, you're making the decision that these are less liquid. So the building across the street, it doesn't change in value on a daily basis. You don't sell it in a day. And so you have to be able to match liquidity in the portfolio with the liquidity that you're providing investors. And so we put these caps in place as a safeguard to be able to do that. And I think what has proven out is that good performance has continued even though we had the caps in place. And that just provides a lot of confidence to the investors in the fund and to prospective investors.
Now, as I mentioned at the beginning, BREIT isn't the only thing under your purview. You've got the private wealth solutions, bigger piece of it. What are you hearing from your investors right now? How are they feeling? I mean, and we're talking about mostly high net worth individuals, right?
Correct. They are feeling better. I'd say we moved from negative to neutral. Part of it is, of course, markets are healing. We think you have seen probably the peak of inflation. That certainly seems to be coming down. Investors are able to earn 4.5%, 5% in their savings accounts. You have a big wall of cash that will probably get redeployed. So the conversation is much more around where those investment decisions are going to be made in the second half of the year in 2024. And I would say, even just a few months ago, the conversation was much more around downside risk, what could go wrong. So you're seeing investor confidence move from negative to neutral, and my expectation is that will continue.
How would you marry what we're seeing within construction right now of new real estate starts with where the current state of the industry is, and what that kind of spells out from an investor opportunity or perspective, even going into 2024 too?
So it's a good question, and you have to look at it by sector and by region. So if you're talking about housing, if it's houses for sale, that's a very different dynamic than houses for rent, which is where we're invested. So there's not a lot of movement in houses for sale. There's actually a pretty big drop in housing starts. So new supply is very low. Demand is still there. Interest rates are high. So if you're thinking of buying a home, and you currently have a mortgage where you're paying 3% or 2 and change, it's kind of a hard decision to then say, well, I'm going to buy and now I'm going to pay much, much more than that. People are staying put. That means on the rental side, because you haven't had new supply, just demand continues apace. All that said, the pace of rental increases has definitely slowed. When we look across our entire portfolio, it's still quite a healthy 7% cash flow year over year growth, which for real estate is actually quite good. But when you think about where rental rate increases were and where they've moved to, that's one of the big drivers of inflation coming down.
Interesting and really valuable insights and perspective. Thank you so much for joining us here in studio.
Thank you for having me.
Absolutely. Joan Solotar, who is the Blackstone Global Head of Private Wealth Solutions, here in studio with Yahoo Finance. Also, everyone, switching gears here, Social Security has been a buzzword for those looking to retire as concerns arise about the sustainability of the program. Louisiana Senator Bill Cassidy has been pushing efforts around the system, and he spoke with Yahoo Finance's Kerry Hannon about his optimism surrounding reform before the next election. Take a listen.
I have no optimism whatsoever. And I'm a pretty optimistic person, so I say that with kind of, but let's put it in context. The reason I initially had optimism, the actuaries predict that the program will go, the social will go, the trust fund insolvent within 8 to 9 years. At that point, a beneficiary who's currently relying upon Social Security to pay her bills will see a 24% cut. With that, we put together a program that not only addresses the cut without raising taxes on seniors, without increasing age of eligibility for seniors, put together a program which actually addressed the insolvency, but also addressed other issues as well. We had Republicans and Democrats, but we don't have a presidential candidate or a president who's willing to take it on.
Can you just sort of flesh out for us your idea? You have this, what you call your big idea, which is really interesting, to sort of create this investment fund to supplement the existing Social Security system. And can you just sort of explain what that's all about and how you sort of respond to any critics of this idea?
Gary, you put it so well. We would set up a fund, 1.5 trillion funding over 5 years. And we would allow that to be invested, no money from the Social Security Trust Fund, none of that, but it would be separate dollars. And we would hold that in an escrow account and just allow a return upon the return. Whatever dividends that would return would go back into the fund. And over 70 years, it would grow. And as it grows, the rule of 12, towards the end, it's doubling. And it ends up growing enough that it takes care of 75% of the unfunded accrued liability within the Social Security program.
So it's
Now,
not
along the way-
privatizing it, right? Is it?
Well, no, but different from previous proposals.
Okay.
George W. Bush created individual accounts for beneficiaries. We don't do that. We continue to pay scheduled benefits per the current schedule. All the risk is borne by the fund. And so a year-to-year fluctuation, of course, is going to occur, but it does not imperil the benefits that someone is currently receiving. But we do know over that long of a time frame, if history is any guide, that you're going to see a certain increase, and that increase, again, by conservative projections, will offset up to 75% of the unfunded accrued liability.
You know, and a second idea, is there any way around this notion of increasing payroll taxes as part of a comprehensive Social Security deal? Would you support a plan that included that in any way?
If by increasing the payroll tax, you mean increasing the rate, no, we do not have that as part of our plan. With a very small caveat, but that is not what we're doing with ours. We're not increasing the rate. What President Biden has proposed is increasing, applying payroll taxes to everybody making over $400,000. Now, the only problem with that, he's proposed it for multiple other programs already, to a tune of about $4.5 trillion. And now he wants to add an additional amount on top of that $4.5 trillion he's already applied it to. Additionally, under President Biden's plan, he does not index that 400,000, which means over roughly 15 years or 20 years, everybody will be making over $400,000, or at least everybody's income will be taxed, even if it is currently less than 400,000. I think you follow what I'm saying.
I do, yeah.
So we're different from the president's plan in we don't increase the rate, and we don't apply it only to people who make over 400K.
Okay, thank you. Now, some other possible smaller efforts that people might be able to see sooner, and one is around giving people more information about when to first claim Social Security. And I know this is something you've co-sponsored. Can you elaborate on that a little bit and where we might see that headed?
Yeah, so there is you can right now take early retirement age age 62. If you know you're about to die of cancer and you've got 3 years in which the doctor tells you you're probably going to die, take your benefit age 62. But for most people, it's wiser to wait until age 70, because over the course of a normal lifespan, you'll receive more money if you wait until age 70. We are trying to help people understand that and putting out information that would educate the beneficiary. It is wiser to wait in a variety of ways, but it is wiser to wait. And that's what we're trying to help people understand.
And what are the chances that these efforts could wind their way through Congress, in the coming months? And what chances do they have?
I don't think that our big idea will become law until we have a new president. Both Biden and Trump have the same plan for Social Security, which is a plan to do nothing, which therefore is a plan that beneficiaries will get a 24% cut. But I think once the political season is over, I'm hoping that sanity returns and folks will say we cannot allow people to get a 24% cut. By the way, Carrie, if that occurs, poverty among the elderly will double. Now that's remarkable. Poverty among the elderly doubles if this occurs. We have to stop it. And I think that kind of demand will make people amenable to our proposal. It's not a free lunch, but it is something which I think will benefit all.
And two more quick questions. The next one, any hope for any real debate on Social Security in the 2024 campaign?
I don't think so. We had 14 senators. It was public. We had 14 senators, 7 and 7 Republican Democrat. We have briefed the White House. The White House has said that, yes, indeed, we briefed them. But when President Biden came out of the State of the Union speech, he did not speak about the bipartisan plan, which had bipartisan support in the House and the Senate. Instead, he focused on one Republican senator's plan, a plan that particular Republican senator had walked back from. It became very clear after that he was running for re-election, and he was running for re-election on Social Security, attacking Republicans, and everything fell apart. Because, by the way, you need a president to sign a bill into law. I'm very disappointed that Biden did that. It destroyed an opportunity that was there, and it makes it more likely that one day somebody's going to get a 24% cut, or if we try and borrow our way out of it, that we borrow our country into indebtedness like you've never seen before.
And finally, just a newsy kind of thing. What's your reaction to President Biden's intent to nominate former Maryland Governor Martin O'Malley to Commissioner of the Social Security Administration?
I've not had a chance to evaluate it, but if anyone's nominated who refuses to acknowledge that if we don't do anything, that there'll be a 24% cut, and simultaneously admits that adding more taxes on those who make over $400,000, when the president has already proposed $4.5 trillion of extra taxes on those folks, is not a real plan. That is something which is a fig leaf. And so I look forward to speaking to Mr. O'Malley. I'm hoping that it'll be more intellectually honest.
That was Louisiana Senator Bill Cassidy alongside Yahoo Finance's Carrie Hannon. As the 2024 presidential election draws closer, the first predictions for the race are giving a slight edge to Democrats. The Cook Political Report gave the Democrats 247 electoral votes and Republicans 235, leaving 56 still up in the air. Yahoo Finance's Rick Newman joins us with the details. What do we do with this information, Rick?
Well, pay attention to those 56 votes. Those are the toss-up votes. So it looks as if these forecasts that are starting to come in are basically saying it's going to be sort of a replay of 2020, at least in terms of the states and the portion of voters inside those states that determine the election. That's whether we have Biden versus Trump round two or two completely different candidates. But this is the Cook Political Report. They're an important forecaster, and they're saying that the toss-up states that are going to decide the election are Georgia, Pennsylvania, Wisconsin, and Arizona. And if you take three of those states, Wisconsin, Arizona, and Georgia, those are the states that decided the 2020 election. And more than that, Biden won all three of those states, but he won each state by less than 1% of the vote in those three states. And that's what gave him the majority of electoral votes. So basically this forecast, and this could change, but for the moment, they are saying it's probably going to be the same thing over again. It's going to be a small group of swing staters, swing voters in those three or four states that are going to decide who the next president is.
Well, we'll see how it all plays out. Thanks for giving us that early look here. Appreciate it, Rick.
See you, Julie.
We got much more coming up today on Yahoo Finance, including my interview with the CEO of AGCO, the big agricultural equipment maker. That's coming up at 3 p.m. The company reported earnings, raised its forecast. The stock's actually trading a little bit lower. I'll speak to Eric Hansotia, the CEO, about that.
Love agriculture. Big in the state of Pennsylvania, by the way.
That is true. Where,
that
in case you didn't know, that's where Brad is from. You might have mentioned it a few times. Have a great day, everybody. Rochelle Kubo's up next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. Meta was the latest big tech giant to report earnings, with CEO Mark Zuckerberg touting a good quarter for the company. But what's next for its latest release, Threads? We'll have more on that coming up. And Royal Caribbean shows signs that cruises could be back as the company boosts its outlook. We'll speak with the CFO this hour. Plus, a Barbie blowout. We'll share our interview with Mattel's CEO on what he's calling a milestone moment for the company. But first, let's check in on the major indices. As we can see here, green across the board here. A lot for investors to digest, including second quarter GDP growth, stronger than expected, coming in at 2.4%. You see the Dow there, up just slightly though, about 30 points, pulling back some of those gains. The S&P 500 also up about 0.5% or 21 points, and the tech-heavy Nasdaq, really the strongest gainer so far this morning, up almost 1% there, or 135 points. Let's also check in on the Treasury market, as we do see some of those recession fears starting to ease, at least in the short term. The 5-year now up more than 3% on the day. As you can see, they're up just about 0.12 there. And we can see the 10-year dipping below that 4% mark, and that's at seeing gains of 2.62%. They're about 10 on the day there. And taking a look at the 30-year as well, also seeing those yields up about 1.8% there, ever so slightly as well. But as we can see, some of those recession fears, at least for now, starting to recede. All right, we'll take a look at shares of Meta surging today on its second quarter earnings. The company's results and earnings call seemingly boosting investor sentiment. Joining us now with her insights into the call is Yahoo Finance's Shauna Smith. So Shauna, how would you characterize the call?
Rochelle, it was a solid call, and let's talk about exactly why. So we got the results after the bell yesterday. We know Meta beat on both the top and bottom line. The guidance was very strong here, but Zuckerberg calling this the most exciting roadmap that he's seen at Meta for a while. Let's talk about the three takeaways first, because first up, there was a lot of speculation going into Meta's report about whether or not we were going to see this recovery in the online advertising market, and we did. We know that that is very important here for Meta, also very important for many of its competitors within the tech industry here going forward. In terms of that revenue growth that we saw for the online advertising market, that was up 12% on a year-over-year basis, and some commentary during the call from CFO Susan Li, who's going to be on Yahoo Finance later on today. She said that some of that growth was attributed to increasing spend from online retailers, but also Chinese companies, a trend that we have seen now for some time. Second up, it's committed to its cost cuts, the year of efficiency, and that has been paying off. We know that Meta has worked hard to slim down its workforce. They've actually cut more than 21,000 jobs in recent months. Zuckerberg saying that he is committed to this. He is committed to being a more lean organization. We know that they have dealt with some of the hierarchy issues that Meta has had. They were able to demote, I guess you can say, some redundant positions that they have had now for quite some time. That is helping boost results. That is helping get them cut their costs here. And now it's all about stability going forward. Zuckerberg reiterated that a few times in this call, saying that is his message to employees. Now, and third, we got to talk about AI, because that is a big reason why I've seen this massive run up in Meta since the start of the year, and a massive run up really almost across the board when it comes to some of these larger tech names here. You can see up 164% year to date. And taking a look at that 1 year chart, now back in November, we were just above $70 a share. This massive run up, the stock more than tripling, $318 a share here today, with the stock up just about 6.5%. Zuckerberg, like I said that this is the most exciting roadmap, the release of new AI products that's already helping the company. CFO Susan Li also mentioning in this call that advertisers, they're able to better gauge the engagement here on their ads because of Meta's AI technology, and that is leading them to spend more on their platform. Certainly something that Meta is excited to see, trends that are very important here for the future growth of the company. We also heard from Mark Zuckerberg on the call, touting some of the advancements that Meta has in AI. Let's play a quick soundbite from what we heard from Mark.
Investments that we've made over the years in AI, including the billions of dollars we've spent on AI infrastructure, are clearly paying off across our ranking and recommendation systems and improving engagement and monetization. AI recommended content from accounts you don't follow is now the fastest growing category of content on Facebook's feed.
So breaking this down even further, Rochelle, Zuckerberg pointed directly to AI, saying that it boosted the time spent on their platforms by about 7%. Engagement is so critical here for Meta. There are so many competitors out there. They're doing everything they can to get users to spend more time on their platforms. At least for right now, they're showing that AI is really giving them the advantage here.
And speaking of how they're competing, was the new app Threads a major topic of discussion on Meta's second quarter earnings call?
Yeah, it was no surprise. Obviously, there's lots of questions about how Meta plans to monetize that. Zuckerberg did address that in his opening statement, saying right now they are focused on the growth of Threads right now. It has over 100 million users in less than a week. Clearly, this has really resonated better than some of the other most recent products when it comes to virtual reality. So Threads is something that at least users were interested in at first. There have been reports just about the drop that we have seen in engagement. But in terms of the tone on the earnings call, Mark Zuckerberg was very encouraged by the success that we have seen so far when it comes to Threads, also saying that he's quite optimistic about the trajectory going forward. So, Rochelle, overall, my vibe was good here for Meta. We're seeing that reflected in the stock price today, up 6.5%. So I think this quarter certainly lived up to the street's expectations.
Certainly seems to be. Great stuff there. Thank you for that breakdown. Our very own Shauna Smith there for us. Well, Meta's new Threads platform is now the fastest growing app in history after adding those 100 million users in under a week. But can the new Twitter rival hold people's attention, or is it just a fad? In the company's earnings call last night, CEO Mark Zuckerberg seemed just as surprised by the app's success as everyone else, but tried to show confidence in his ability to grow the platform. Here's what he had to say.
We feel like we're getting to a good place on that with Threads. There's still a lot of basic functionality to build. Once we feel like we're in a very good place on that, then I'm highly confident that we're going to be able to pour enough gasoline on this to help it grow. Once we get to the point where we feel good that everyone who's using it is going to continue using it at a high rate.
So can Zuckerberg throw enough gasoline on that Threads fire? Joining us now is Ari Lightman, Carnegie Mellon University Heinz College professor and digital media and marketing, and Andrew Boone, JMP Securities Managing Director and equity research analyst. A big thank you to you both here. So Andrew, from an investor perspective here, what does Meta need to do with Threads to really differentiate it from what's already out there in terms of platforms like Twitter or some of these other platforms?
I think what they need to do is build up the social connections that are available on other platforms that Meta already offers. And so I think that is making the recommendations in terms of content, bringing more users on, especially kind of those one-to-many experts that I think Twitter is today known for. And then once they get those users that are very prolific in terms of producing content, then I think it's about just making more users aware of it. And they already have the user base that they're porting in from Instagram, from core Facebook to be able to do that.
And I know a lot of people, at least with some of these initial sign-ups, it's about curiosity. I mean, I signed up just to see what all the fuss was about, see how I could use it. But we actually spoke to some social media users on the streets of New York about Threads. Here's what they had to say. I'll get your reaction on the other side.
It's too similar to Twitter, and I have Twitter and I don't use it anyway. I'm just kind of tired of Instagram kind of copying a lot of the things that other apps have been doing.
It's fake Twitter. Like, nobody want to be on Threads if you got the Twitter going, feel me?
I set up an account. I don't ever go on it.
I didn't feel the need to download it because it didn't feel new.
I can definitely see Threads becoming a competitor with Twitter.
So Ari, you have a lot of people saying they either don't like Threads, it's too close to Twitter. Ari, do you see that tide turning for Meta then, or have they essentially cannibalized enough of their audience at this point?
Potentially. It depends on how they execute associated with features and functionality that people are used to within some of the larger microblogging platforms like Twitter. But it also, they have to differentiate themselves from a variety of other platforms that are just launched themselves recently in the past year or two, including Blue Sky, Mastodon, Post, Spill, those sorts of things. So there's a lot of fragmentation in the market, and they really have to execute very, very well. They can't rely on sort of their current user base. They need to differentiate and leverage what they have in stock, which is really sort of a tie-in to some of the other major platforms that they utilize, including WhatsApp and Instagram and Facebook, of course.
And Andrew, how do you see Threads needing to evolve from this point forward? It does seem to be in the sort of figuring it out. It's your MVP, your minimum viable product here. And as Mark Zuckerberg was saying, there still a lot of functionality they still need to be in. What do you see investors really honing in on to really before they get excited about where it could go from here beyond its potential?
Well, I think it's important to contextualize that point, right? It really is an MVP at this point in terms of they started this 5 months per press reports before it kind of came out. So, we're half a year old at this point. In terms of other social platforms that have really gained traction, it's historically been a new format, right? Like TikTok was recommendation of short form video. Instagram was really a photo first kind of experience. Core Facebook was the feed. Snapchat was the ephemeral nature of that. And so we'll see how they innovate and we'll see how Threads develops, but it may require something that's newer in terms of really jettisoning users from Twitter onto Threads.
And Andrew, how do you see this progressing? Because we know with Twitter, one of their problems was monetization. We know advertisers were sort of honing in on that space. What then happens with Threads? How will they do differently? Or what can they perhaps learn from how Twitter has interacted with its advertisers?
There's certainly a core asset that Meta just brings to the table in terms of 12 million advertisers that are already on the platform. And so let's just talk about Reels really quickly. So what was the new information that came out last night? 75% of advertisers are on Reels today. And that's just so impressive in terms of this being about a year-old product and you have, 3/4 of adoption of the overall advertiser base. Extend that to Threads and you start to get something that's exciting where you have density in terms of an ad auction, where you have the data that's available across the rest of the platform. I think the monetization side's pretty clear. Really, the question is around engagement and building that scale.
And Ari, regarding engagement here, as we look at this push for these everything apps, as we saw with Twitter, now X trying to encompass everything, and we are seeing Meta now also taking on some of that as well. What happens here in terms of the potential for antitrust issues as they do really try and become these everything apps to people?
So part of the large issue is this idea of surveillance capitalism associated with if you go on an app, you sign agreements, I collect a variety of data on you in terms of your utilization, your interests, your connections, and basically monetize that for advertisers in terms of hyper-targeted advertising. So that's sort of the norm. Unfortunately, with companies like Meta, that accounts for 95% of the revenue base. So this push towards an everything app is really looking at things like WeChat, which diversifies the revenue base associated with payments, associated with interactions, a variety of different utility that you could do within an app. We're trying to get there, and social platforms are having a really hard time because of the partnerships and sort of the ability to integrate and create greater levels of utility across the board. It's really challenging to do, but to Andrew's point, I think with advertisers, really providing them less volatility, as well as providing them unique analytics associated with trending and analysis would be very beneficial associated with keeping that revenue base going, which is vital.
And Andrew, do you have any concerns, I guess, from an antitrust perspective about what you're keeping an eye on as an investor as potential headwinds to Threads growth and how it really fits in with the broader ecosystem of Meta?
You never know what you don't know, right? In terms of antitrust and who's going to come at the various kind of tech mega caps and what's available. You feel much better about the EU-US agreement in terms of data transfers. I think that was a risk that everyone was aware of in terms of kind of the potential over the next 12 months. So that's now been solved. In terms of antitrust more broadly, we'll see. I don't think there's anything that's imminent, but you just don't know.
Indeed. Well, a big thank you there to our panel. Ari Lightman, Carnegie Mellon University Heinz College Professor, Digital Media and Marketing, and Andrew Boone, JMP Securities Managing Director and Equity Research Analyst. A big thank you to you both this morning.
Thank you.
Thank you.
All right, let's take a look at some trending tickers so far today. Shares of Lam Research are jumping Thursday morning after the chip-making equipment supplier posted better than expected earnings. That's thanks to a surge in demand fueled by rising AI tech adoption. Revenue for the quarter came in at $3.21 billion versus the consensus estimate of $3.16 billion. In the company's earnings call, CEO Tim Archer was pleased about the profitability levels that surpassed the street's expectations. Lam Research also updated its Q1 2024 guidance. The company sees EPS reaching anywhere between $5.30 to $6.80. Well, semiconductors are seeing a nice pop today after Lam Research's earnings. Take a look at Marvell, AMD, Micron, and Qualcomm, all trading higher on that news. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Mike Wilson of Morgan Stanley has been bearish for quite a long time. And in a note, he just said, we've been wrong. Now, I'm not going to ask you about what he said, but I am curious, like, in a strategy making role, just quickly, how often you sort of re-examine your assumptions?
Constantly. Every single week we meet together as a group and we check in on how our thesis is playing out, new data. The trick is there can be a lot of noise day to day. So really the trick is really figuring out what's the actual signal, what has actually changed, and not getting whipsawed week by week. But indeed, we have gotten new information over the past quarter that has changed the view. The first is the enthusiasm about artificial intelligence and how that's for real and can boost valuations in advance. And then also in terms of the macro picture, we do believe that soft landing odds have risen given the data we've gotten recently.
Let's do a check of the markets, sponsored by Tasty Trade. Still all three in positive territory, but ever so slightly here. We're seeing the Dow sort of oscillating there, just barely in the green, up about 8 points, but relatively flat at the moment. Some of that buying action slowing down across the board. The S&P 500 there also up about 20 points, or about 0.5%. The one that holding on to the gains the most so far is the Nasdaq, still up about 1%, or 137 points so far this morning. Well, as inflation continues to show signs of cooling, this may impact your Social Security. New estimates show that next year's Social Security cost of living adjustment will be over 2/3 less than the increase in 2023, according to the Senior Citizens League. So what does this mean for your retirement planning? Well, Scott Inman, GenWealth Financial Advisors financial advisor and host of Get Ready for the Future show, joins us now. Thank you for joining us again this morning. So as we get ready for the future, what do you see as the biggest threats at the moment to people's retirement planning?
Well, when it comes to the Social Security component, I think the big thing is what's going to happen to Social Security in the long run. And that's a big question that we get in our client meeting rooms. Is it going to be there? And, the reality is it is going to be there. What it looks like is really the big question, right? So the Social Security Trust Fund is predicted to be depleted in the next decade. So what does that mean? Well, if that happens in the first part of the 2030s, then benefits would have to be cut. So your Social Security benefit across the board for current and future recipients would be cut by a projected 23%. Now, do we believe that's going to happen? No. But the reality is any fix has to come from lawmakers in Congress. And if lawmakers in Congress have to change Social Security, the ways they're going to choose to fix that are not going to be politically popular. For instance, just last month, there was a Republican proposal to raise the full retirement age to age 69. And it was met with a comment from one Democratic lawmaker that Republicans were trying to renege on a sacred promise made to Americans. Well, it's being used for political gain, right? But it doesn't solve the problem. You're either going to have to raise the retirement age, you're going to have to raise taxes, or a combination of both and other fixes in place. And while it won't get done anytime soon, it should before the midnight hour. And if it does, I don't think there's really any serious threat to Social Security. But to your point on the cost of living adjustments, year to year, it is always going to be figured on the tail end inflation data of the previous year. And obviously with inflation cooling, the cost of living adjustment is going to be lower. And so you can never really count on your Social Security benefit keeping up with inflation.
And to that point, I'm also looking at your notes here about Medicare, and you saying that healthcare costs could be the biggest expense that you'll have in retirement. Talk about the changing dynamics there.
Yeah, that's the other thing, too, because when you talk about inflation and its connection to healthcare costs are rising at a much bigger clip than food and energy prices usually are. In fact, a Fidelity study out this year said that the average 65-year-old couple, through the remainder of their retirement, through the remainder of their lives, can expect to pay out of pocket $315,000 in healthcare expenses. Now, that's counting premiums and deductibles and coinsurance and all of that, and prescription drugs and long-term care. So people have this idea that once they reach Medicare age, that everything's covered. Clearly it's not. And the premiums you pay have to be accounted for too. And you have to be careful about that too, because the baseline premium for Medicare Part B, as you know, Medicare Part A is free, but you pay for Medicare Part B beginning at age 65. And that's $164.90 a month per person. That's pretty tolerable, but it is also it changes based on the amount of income you're receiving. So if you're a retiree that has a pretty big pension and you're pulling pretty big money out of your 401ks or IRAs, your income could send you up to $428 in premium on a monthly basis for each member of that couple. So it gets to be pretty much a big cost potentially if you're receiving high income. So there's that. So you have to have a plan for healthcare costs in retirement. We recommend taking a look at HSAs in your pre-retirement years if you have access to one, because that allows you to have tax-free money to pay for healthcare costs in retirement. And then the other thing is you have to have a plan for long-term care. Medicare does not cover long-term care coverage in a nursing home or other places. So you have to have a plan for that. Do you have enough assets to self-insure? have a bucket of money out there that is moderately invested that you can go to in your 70s or 80s whenever that long-term care need arises? Or do you have to leverage an insurance company and buy a long-term care insurance policy? You have to make that decision. And the best time to do that is before you reach age 65.
And so for people who are wondering how they should go about this, I mean, some people are increasingly now taking out home equity loans. So what's a smart way to do it so that you're not really being penalized here, but you can really try and figure out how to calculate what you're going to need in terms of what Social Security won't cover and what Medicaid won't cover?
Yeah, so for sure, Social Security is not even meant to cover all of your expenses or all of your lifestyle in retirement. The way we go about that, I would think of it like this, Rochelle. If you think of it as building a house, you put your foundation first down when you build a house. It's not exciting, but it's the most important part of that house. The most important part of your retirement is your required income. What are you going to need on a month-to-month basis just to pay the bills? What's the cash outflow? You may have a mortgage, you may not, but you're always going to have insurance, and you're always going to have taxes and utilities and food and gas and those things. Figure up that number and what you're going to have there. Does your Social Security checks, and if you have any other guaranteed income sources available to you, will that meet your guaranteed income or your required income need? If not, you're going to have to find some way to fill that gap because your expenses need to be met with guaranteed income. You may need to look to something like an annuity with a portion of your assets to provide a rider that would allow you to fill that gap. Then the next step is your desired income. What do you want to do in retirement? What's your lifestyle look like on a month-to-month basis? Monetize that. How much extra money would you like to have in discretionary spending? That's the middle of the house, the framing of the house. And then the top of the house is your attic space, which is the stuff you put up there that you think you're going to pass on someday, right? That's your legacy. There's a component to that too. Are you charitable minded? Do you want to make sure your kids have some money after you're gone? You have to plan for that. But it all comes down to income. People walk into our office a lot of time, Rochelle, and they say, hey, do I have enough to retire? That's their first question. And maybe they have $1 million, maybe they have $700,000. We can't answer that question until we answer those income questions.
And that makes sense, because if you don't know what sort of life you want to live in retirement, then the numbers aren't really going to mean much of anything. Lots of important context there. I know people appreciate it. A big thank you there to Scott Inman, Genwealth Financial Advisors financial advisor and host of Get Ready for the Future show. Thank you so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
East Chinese tech sector is seeing a steep rebound today. It's up more than 20% from its May low. Let's bring in Yahoo Finance's Jared Blickery to discuss this more. Hey, Jared.
Hi there. I'm looking at the Hang Seng here, and you can look at various subsectors in tech, but this is basically a tech index. Let me just show you what's been going on year to date. Now, we are substantially off of this high right here, but as you point out, we have been picking up recently. Now, in the context of its prior low, its most recent low was really late last year. So this market was technically in a bull market, if you believe in the 20% rule, late last year, and it's still in that bull market. And let me just show you what has been happening with Chinese shares recently. So these are NASDAQ Golden Dragon components. Here's what's happening today, kind of a mixed board, but different picture when you take a look at the 5-day. Lots of big pushes here. Pinduoduo up 14%. That's a pretty big one. Alibaba up 6%. JD.com up 5%. And then you take a look at what's happened over the last 3 months, and we sort by performance. We can see some really huge outperformers. The EV space has been hot overall, so not surprisingly, we're seeing XPeng in the upper left. That's up 108.7%. We see NEO on the top line, that's up 70%, but we have some others too. I mentioned Pinduoduo, that's up 30%. So what has been happening here? Let me show you the buying that has been taking place over the last week. Now, this comes from Goldman Sachs. This is their prime brokerage book, and this is showing huge inflows into the Chinese market right here. This chart goes all the way back to just before 2019, so late 2018. But what I'm seeing with these spikes that we're seeing, and here's another one from late last year. Here's another one in probably mid-second quarter of 2022. And here is in the beginning of 2021, but you line up these points along with the Hang Seng that we were looking at originally, that is the stock market, those are actually reversal signals. So unless we're in some kind of a new market paradigm right now, investors may not want to be chasing equities from China at these lofty levels. Here's the Hang Seng one more time, and if we take a look at the 3-year, we can see indeed the big spike that we saw in the chart. Those biggest inflows corresponded to the top in 2021, early that year in the Hang Seng. Also, the Chinese currency has a lot to do with what's going on. The Chinese yuan, that has been largely weakening over the past few years. And here is a 3-year view, and you can see we're up. By the way, up means a weakening with respect to the yuan. So it's at some of the weakest levels that we've seen since 2007. You'd have to go all the way back here. The Chinese have been trying to stimulate through the property sector of their economy, but it's been very targeted. So again, without blanket stimulus, it's hard to imagine continued up growth in these Chinese equities, guys.
Indeed. Appreciate that update there, our very own Jared Blickery. Well, switching gears now to travel. Now, it's been rebounding strongly since the end of the COVID restrictions. It's been hard not to see the struggles that airlines are going through to keep up with demand, as the TSA reports record numbers going through airports. But there are alternatives. Cruises, for instance, have also seen record highs, and according to a JP Morgan report, even surpassing pre-pandemic levels of passengers. Royal Caribbean Group just came out with its earnings, seeing a beat on top and bottom lines. Let's bring in Royal Caribbean Group CFO Naftali Holtz to discuss this more. Good to have you back on the show here. We see the stock price being rewarded so far this morning on that. What do you think is the key to the success here, especially when you think of the demand versus where we were pre-pandemic?
Yes, good morning, Rochelle. First, great to be with you. I'm here today at our innovation lab. This is actually when we design our innovative ships. We use very advanced technology, so it's exciting to be with you today. And as you mentioned, we're continuing to see very strong demand. You can see that translating to higher second quarter results and us raising the full year guidance really on just the accelerating revenue and demand for our cruises. And we continue to see customers engage, willing to come on our ships and spend, and really the value proposition of cruise and just the amazing experiences that we deliver are really fueling that demand.
And talk about the demographics that are really fueling some of this growth. Obviously, the image of what used to be the traditional cruiser, but then you also have the under 60 group, which does seem to be the fastest growing group for cruises. What are you seeing with Royal Caribbean, and what sort of investments are you making to really woo that audience?
Yeah, so we first we see very broad demographics, and really because our vacations are appealing to a broad range of vacationers. It could be, like you just said, the 60 plus that obviously are retiring and having a lot of time that wanted to explore the world. We see young families that are looking for family vacations. And we also see multi-generational travel. So the grandparents, the parents, and the kids together. And this is really how we are designing our ships and our experiences to appeal to that broad base. And it's very even in terms of the demographics across the various age groups. And what we're focused on is to making sure that everybody has a fun vacation. So it starts with the way we design the ships, what is on the ships, and kind of the experiences that we have, the way we design the interactions with the customers, and just everything that we offer appeals to that broad demographics. And we see very strong demands across all of them, as really what the consumer has done is been shifting the spend from goods to experiences. And obviously we are squarely in the experience space. And just the value proposition and what we offer is very, very attractive and appealing to those consumers. And we see that translating into demand across our products.
And of course, I want to ask you, as you're in your innovation center there, about Icon of the Seas. I mean, we know that they completed their initial sort of test cruises here before we have the big launch next year. I mean, when you look at some of the images here, I mean, this thing is gargantuan. Talk about the idea of really having this huge ship that's going to be the biggest cruise ship in the world versus, say, broadening the fleet with smaller ships to serve more customers.
Yeah. First of all, we are very, very excited about Icon on the Seas. She will join our fleet very late this year and start its revenue cruising next year. And the demand has been outstanding. And there's a lot of excitement within our consumer to explore the ships. We've taken this to a different level. This will be our ultimate family vacation. And we will have experiences for, as I just mentioned, just for all the demographics, including families with young children. In terms of the size, yes, it is our biggest. It's actually size-wise, and it's not that much bigger than our Oasis class, but it can accommodate more passengers, and we're excited about that. But the ship has actually more public spaces per passenger than any of our other ships, and the way we've designed it was very innovative to make sure that we can accommodate and everybody can get an amazing vacation on that ship. And obviously, we'll go to our Caribbean, including visiting our amazing island, Perfect Day at Coca-Cola. So this will be an amazing vacation, and we're very excited to have her join us next year.
Now, I know for people who are wondering about the carbon footprint here, we know that Royal Caribbean has been pushing for more sustainable use, whether it's in the fuel that it uses, whether it's LNG and other things like that. But talk about when you have a ship this size, how you sort of manage those expectations when it comes to the footprint of some of these massive cruise ships.
Yeah. So one of the things that we're very proud of is obviously our continued innovation and advancement in carbon intensity and energy efficiency. So every ship, even within the class, makes that progress. And Icon is actually going to be our most energy efficient ship in the fleet. It will use, as you said, LNG fuel. We are going to have shore power on her, such that when she is at port, we can use the power at shore. And then lastly, we have a very innovative waste management program where we take waste on the ship and translate it into energy. So we have a lot of very exciting things. This is a very important thing for us. And in addition to having those amazing vacations, we obviously very much focused on making the ships more efficient and in that area.
And just lastly, very quickly, any concerns that consumers might start to either pull back or downgrade from some of their cruise experiences as they do sort of weigh what might happen with a potential recession?
Yeah, so we continue to see, and you can see that obviously in our results today and our forward commentary and what we're seeing, not only for the quarter and for the rest of the year, but although it's early, what we're seeing into 2024, we see very eager consumer that is very healthy, very excited to seek our vacations. So we do not see any slowdown. We see very eager consumer that is spending more on the ships, obviously for our vacations. So we're very excited about what we're seeing for the rest of the year and into 2024.
Well, investors certainly seem to be on board, especially this morning. A big thank you there for joining us in Yahoo Finance, Naftali Holtz, Royal Caribbean Group CFO. Thank you so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
At the end of this earnings season, will stocks be higher or lower?
Well, the short answer is I don't know. I don't think anybody does. But I think that if you don't get the similar pattern that you saw in Q1, where the bar was lowered so much, then it was just easy to step over for pretty much every company. Then you had this pretty miraculous rebound into flat territory, which is impressive when you go from down 5% to no growth, that climb upwards. And I think actually that had that was a big part of why the rally kind of persisted throughout the second quarter. So if you don't get that and you actually get cuts to guidance, which we've already started to see for the rest of the year, my guess would be you probably have some more stumbling amongst the bigger companies and the more high-profile names.
A challenging second quarter and a sales decline in North America isn't getting Mattel's CEO down. That's because it's the summer of Barbie. Starring Margot Robbie, the movie phenomenon has already sold $356 million in tickets globally. Ynon Krey says they've captured a cultural moment while hinting that the holiday shopping season could be strong for Barbie-related toys. Now, this is a crucial area for the business, especially as Mattel only gets a fraction of the sales from its myriad of brand partnerships. Krey spoke with Yahoo Finance's executive editor Brian Sozzi on all this and more. Take a listen.
It is great to see the success at the box office. We could not be more proud of Greta Gerwig's visions and execution of what is now becoming a true cultural phenomenon. It was never about just making a movie. We wanted to create an event, a cultural event. And it's exciting to see all of this vision coming to fruition.
Can you, before we get into the quarter as well, can you explain to investors what other content you have coming down the pike, and what does this movie mean for the potential profits from all this other content that you have coming?
You know, this movie is really a showcase for the cultural resonance of our brands, our ability to attract and collaborate with top talent, and very importantly, our capabilities to take our brands and elevate them to create cultural moments. It speaks to the potential of Mattel Films and the significant progress we made on our strategy to capture the full value of our IP. So it is an important moment for Barbie. It's a milestone moment for Mattel in executing our strategy. And also it's a historic moment for cinema in bringing for the first time the Barbie brand to the big screen in live action. So exciting day, exciting time all around.
You're right. I mean, you have captured the cultural conversation, Anand. Now, within that portfolio of content that you have, are there other Barbie-type movies, and do you run that same distribution playbook?
Well, for Barbie itself, this is the beginning of a journey. Success breeds success, and we're not looking to stop here in terms of how far Barbie can grow and expand in terms of additional offering and additional movies, television series, and others. We also have 14 other movies in development, so we have a very strong slate of offering. And we're not saying that every movie will be as successful as Barbie, but we absolutely look to apply the same methodology, the same approach in collaborating with top talent, in trusting and amplifying their creative vision, and bringing our own marketing and demand creation expertise to the table. So it's not just about owning the portfolio of a very strong collection of strong brands, but also partnering with creative talent and then amplifying what they do through our own marketing capabilities. And in this case, collaborating with Warner Brothers was a phenomenal success. Warner Brothers has done an amazing job in marketing the movie and collaborating with us on creating this event. Obviously, it all starts with having a very strong creative execution led by Greta Gerwig, top talent, incredible cast led by Margot Robbie and Ryan Gosling, and an incredible music offering, the Barbie album produced by Mark Ronson that brought to this project some of the most celebrated music artists of our generation. So all of this combined around the Barbie brand that, just as a reminder, was already a very strong brand coming into this project. A strong brand, one of the top brands in the industry, the #1 brand in the entire toy industry for 2 years in a row, and of course, a very strong platform to create something so special and so unique.
Let's jump on the earnings results, Anand. Does this quarter get you down a little bit? Like, shucks, I got to report down sales and down gross billings at the same time where, a property in this movie is just blowing up.
This quarter, we continue to improve our position. We exceeded expectations, both at the top line and the bottom line. We grew our free cash flow by more than $200 million and are still guiding free cash flow to exceed $400 million for the year. So we feel very good about this quarter and believe the company is set to achieve the guidance that we put out for the full year.
Within that free cash flow outlook, Anand, how do you plan to use that cash?
Well, we talked about our capital allocation priorities in terms of continue to invest in organic growth for the company, continue to manage our balance sheets, and maintain and strengthen our position financially. And as you know, we recently achieved investment grade rating, which was an important milestone in our turnaround to achieve in terms of our financial resilience and strength. We look to continue to pursue opportunities in terms of corporate development, M&A, and the like, and also continue to purchase shares to manage and optimize our overall financial standing and balance sheet as a whole. So it is part of our capital allocation priorities, and generating cash and having a strong financial profile is now becoming another important lever to execute our strategy.
We've been talking the past few quarters, Anand, about a more cautious consumer, and I see your sales down in this quarter. Are consumers spending a little bit more? Are you seeing any improvement there?
Yes, we do expect to see a positive holiday season overall, but we have seen softness in the second quarter, more than we expected in the industry. That said, POS trends have improved significantly in heading into the third quarter to date, and we expect both total company and, of course, Barbie POS to be positive for the year.
I think you're going to get a lot of questions, Anand, on, given the popularity of the movie, You did beat expectations, at least relative to analyst estimates for this quarter. Why not come out and raise your earnings guidance? You know, do you think Barbie has that power for this holiday season where you can see a lot of toy sales?
Well, we could not be more excited with where Barbie is today. Of course, the phenomenal success of the movie is an important driver that really speaks to the strategy. This is not just about the quarter. It's about our strategy, our long-term franchise management strategy. But we still have 2/3 of the year to go in terms of our business. We're seeing softness in the industry, and we are maintaining guidance and expect to continue to grow share and strengthen our position for long-term growth.
I did not miss the fact that your inventory was down year over year. You've worked hard to get that inventory in the right shape. Are you happy with your inventories now? And is the retail inventory correction that you've been talking about, is that over?
Yeah, we've done a very good job managing our inventory. It's down over $200 million. And we're seeing an important improvement in retail inventory. By the end of the second quarter, retail inventory in dollar terms were down double-digit percentage relative to last year. We believe the retail inventory correction is mostly behind us. This is what we expected entering the second quarter, and we're seeing it playing out. And therefore, we do expect the industry to have a positive holiday season and for us to continue to gain share, given our success in executing our strategy.
You're losing your right-hand man, Anand, and Richard Dixon. He's decided to accept the role over at Gap. I mean, it's a tough loss, right?
Yeah, Richard is a friend. He's a colleague. We've been doing this together since I joined the company, and we've had a great run. We wish him success. He's a great executive. And one of his greatest accomplishments at Mattel was to develop and build a very strong team around him. We're promoting 2 world-class executives to overtake what he did in terms of managing our franchises. This is Lisa McKnight, who will run the toy portfolio, the categories, and all of our global brands. And Joe Silverman, who will run all of the non-toy related commercial activities. 2 world-class executives surrounded by a team of excellent executives. We could not be in a better position today. It's a moment in time. This is a juncture for the company following the Barbie movie. All of our product for 2024 is already in place. We're now looking already into 2025. And with that, the team is ready, and we are excited about the next chapter for Mattel.
And lastly, before I let you go, what's left for you to accomplish? So I would say check done on the turnaround. You've achieved that. Improved balance sheet, check done. Barbie movie, check done. I mean, what else do you have left to do at Mattel?
Well, we're just getting started. We could not be more excited about the road ahead. The company is in an exciting position. We achieved a milestone, but we're not done. And there's a lot more to capture. We could not be more excited about the opportunities for us within the toy categories. And on top of it, everything we look to do in continue to expand our entertainment offering. So expect more to come.
I tried to maybe pull off a Ken outfit. No, I can't do it. I can't do it. I try. I can't wear pink, but I do. Support Ken and everything he's up to. Anand Kreis, always good to see you. Congrats on that movie success. It's been a heck of a month for you and your team. Thanks so much.
Thank you, Brian.
Mattel CEO Ynon Kreis there with Yahoo Finance Executive Editor Brian Sozzi. Great stuff. Well, McDonald's posted a beat across the board in its Q2 earnings results Thursday before the market opened, in part thanks to that viral Grimace campaign boosting sales here in the US. Following the results, CEO Christopher Kempczinski and CFO Ian Borden spoke with investors to provide further insight on how the Golden Arches is performing in a, quote, more challenging macroeconomic environment. Yahoo Finance's Brooke DePalma is here with more. Hey, Brooke.
Good morning, Rochelle. That's right. We got some insight as to how exactly consumer sentiment is holding up into the second half of the year. Some top takeaways here include that consumers are, in fact, trading down. We're seeing that consumers are becoming more value conscious when they go and head for their Big Mac next time. And in addition to that, we're also seeing that sales are expected to moderate in the second half of this year as inflation and margin pressures are expected to continue, but we also did see some drivers here. A boost, as you noted earlier, came from that Grimace viral promotion. It only ran from June 12th to July 9th, but it drummed up 3 billion views on TikTok, and they said that viral phenomenon is yet another proof point of the power of marketing at McDonald's. In addition to that, we also saw some campaigns go viral overseas. They said Italian consumers were getting, get this, chicken tattoos or sandwich tattoos based upon their crispy McBacon, and also growth plans were also mentioned in the call. But diving back into that state of the U.S. consumer, CEO Chris Kempczinski did say that the U.S. consumer sentiment hasn't changed dramatically, but it's still far off from where it was back in 2019. He also said that value positioning is allowing the company to gain market share, but there has been slight changes in consumer behavior. Take a listen.
If you look at incomes under 100,000, we're actually doing quite well there, which suggests that we're getting some benefit from trade down, from things like full service dining, casual dine, et cetera. And then even if you go to incomes of 45K and less, our business is performing well there. What we're seeing with that group is we are seeing a little bit of a decrease in order size, but it's being offset by very strong or continued strength in traffic.
And Rochelle, value remains a key strategy for McDonald's as they look to that second half of the year as inflation continues to take a toll on consumers' wallets, but they do remain optimistic.
So what are they saying? Do they give more details about the rest of the year?
Yeah, well, right now they're confident in their strategy, which they dubbed Accelerating the Arches 2.0 growth plan. They think that they'll continue to gain share because of those strategies that they put in place. But CFO Ian Bourdain did say that he expects macro headwinds to continue this year. Take a listen to this.
But we recognize that we're operating in a challenging macro environment where costs remain elevated, customer discretionary spending is limited, and industry traffic is pressured. In line with industry trends, and as inflation begins to normalize later in the year, we expect top-line growth to moderate.
And he went on to say that inflationary margin pressures are expected to continue as well.
It's interesting stuff there, and also was taking a look at what we're seeing with these small store format cosmics that are supposed to be coming out, I guess, in some limited form in some cities. We'll be keeping an eye on that as well. Brooke DePalma, thank you so much. Well, that's it for now. I'm Rochelle Akufa, but I'll be back with you at 11 a.m. Eastern tomorrow. Stay with us.